Please like, share, and subscribe. Wishing you happiness and good luck every day.
Have you ever wondered what the real secret is to successful stock market investing? Well, today we're diving into the mind of a true legend, Joel Tillinghast, and his incredible book, Big Money Thinks Small. So if you're ready to flip what you think you know about investing on its head, you are in exactly the right place. You know, most investors, and maybe you too, are trapped asking this same question over and over. What happens next? What's the next hot stock? Tillinghast just completely throws that out. He says the real key, the question that unlocks genuine wealth, is so much simpler, but way more powerful. What is this thing actually worth? So here's our game plan. First, we're going to take a tour of the absolute madness of the market. Then, we'll pull back the curtain on Tillinghast's secret weapon, his mistake avoidance strategy. And finally, we'll get into 3 of his golden rules that you can use to come out ahead. Let's dive in. All right, first things first, the chaos. See, to really get Tillinghast's approach, you first have to accept a hard truth. The stock market is a pretty wild place, and honestly, our brains are just not naturally wired to handle it. I mean, history is just littered with these moments of mass delusion. Yeah, the tulip craze, the dot-com bubble, you name it. Tillinghast's point is that when the crowd starts running in one direction, logic just gets trampled. It all becomes about hype, headlines, and a whole lot of fear and greed. And just look at this classic example, the South Sea bubble from way back in 1720. We're not talking about a few naive people getting tricked here. We're talking about the smartest minds of the day, people like Sir Isaac Newton, getting totally swept up in it all. The stock went to the moon, and then, boom, it crashed and burned, taking countless fortunes with it. So why does this keep happening? Well, it's kind of like we have 2 different brains. You've got System 1, your lizard brain. It's fast, it's emotional, it's all gut reaction. Then there's System 2. That's your slow, logical, deliberate brain. Now, when it comes to investing, you really want the grown-up System 2 in the driver's seat. Okay, so if our brains are wired to mess things up, how do we fight back? This is where Tillinghast's philosophy is so powerful. It's not about predicting the future. It's about building a system to protect you from your own worst instincts. He calls it the mistake avoidance strategy. And this right here is the core of the whole idea. Look, we all dream of being the hero who hits that game-winning home run. But Tillinghast says that's a losing strategy. The real path to success is to just stop striking out. It's about consistently getting on base, playing a smart, disciplined, long game. His entire strategy really boils down to 5 powerful principles. And while they're all incredibly important, we're going to zoom in on 3 that are absolute game changers. Mastering your own psychology, knowing your turf, and, you guessed it, paying the right price. First up, let's talk about the biggest battle you'll ever face, the one inside your own head. Rule number 1 is all about winning that inner war, recognizing those mental tripwires that are just waiting to blow up your portfolio. And one of the biggest traps is this weird acronym, YSIATI. It stands for What You See Is All There Is. Think about it. A stock is all over the news, it's shooting up, and our lizard brain just starts screaming, "Get in now." We totally ignore the bigger picture, the history, the actual value. And that's exactly how people end up buying high and selling low. The great philosopher Bertrand Russell just nailed it with this one. The less you know, the hotter you get. It's so true. When you're running on fumes, just headlines and gut feelings, your emotions completely take over. And that, my friends, is when the really big mistakes happen. So what's the takeaway here? All that activity, that constant jumping in and out of stocks, chasing the next hot tip, it's pretty much a guaranteed way to underperform. The data is crystal clear on this. The more you trade, the worse you tend to do. You're just generating fees for your broker. And hey, don't just take my word for it. Look at the numbers. Just look. Imagine you have 2 people, each with $1,000. One is a hyperactive trader in and out every 6 months. The other is patient, letting their investments sit for 30 years. The difference is just staggering. The patient investor ends up with nearly double the money. Patience isn't just a virtue, it's a financial superpower. Okay, so we've established we need to be patient, but what should we be patient with? Well, that leads us straight to rule number 2. Stay inside your circle of competence. This is all about being brutally honest about what you know, and more importantly, what you don't. Here's a simple way to think about it. You wouldn't try to fly a commercial jet just because you've flown a kite, right? It's the same thing in investing. Your circle of competence is where you have a genuine, deep understanding, a real edge. It's not about recognizing a brand name, it's about deeply understanding a business. Because the minute you step outside that circle, you're just gambling. I mean, look at these complex things like triple leveraged ETFs. They sound sophisticated and exciting, right? But they're a perfect example of how complexity hides massive risks. These things have weird mechanics that can make you lose money even if you guess the market direction right. It's a minefield for anyone who doesn't understand the fine print. You know, the investing giant Peter Lynch, who actually discovered Tillinghast, put it perfectly. He said, anyone can turn over a lot of rocks, but the winner is the geologist who turns over the rocks and actually knows what they're looking at underneath. That's the difference between being a tourist and a real pro. And now for the final piece of the puzzle. And folks, this is the big one. Rule number 3 is the heart of it all. You have to pay the right price. This is where we learn to see the diamonds in the rough that everyone else is ignoring. So here's the entire secret of value investing in one sentence. Price is what you pay, value is what you get. The whole game is finding situations where you can get way more value than the price you're paying. It's like finding a priceless painting at a flea market. All you need is the knowledge to spot it and the patience to wait for everyone else to figure it out. But here's the catch, and it's a big one. The absolute best bargains are usually found in companies that look, well, kind of broken. They have some big, ugly problem that's scaring everybody else away. Your reward comes from having the courage to look past the scary headlines and act on your own analysis. This might be my favorite line from the entire book. Tillinghast talks about this thing called shadow income. It's the profit you earn from doing all the things no one else wants to do. You get paid for patience. You get paid for being bored when everyone else wants excitement. You get paid for worry, courage, and yeah, even for looking like an idiot in the short term. So in the end, it really all boils down to one question. Are you paying the market for a thrill ride and the comfort of the crowd, or are you making the market pay you for your patience, your hard work, and your courage? The choice ultimately is yours, and that is how you learn to think small and win big.
So what's the real secret to getting rich in the stock market? Well, it's probably not what you're thinking. See, it's not about finding that 1 in a million stock pick. Today, we're going to dive deep into the investor's mindset and uncover why avoiding those huge, catastrophic mistakes is so much more important than a few moments of genius.
I mean, it's a simple question, right? And for pretty much all of us, the answer is a big, loud yes. But here's the twist, and it's a big one. In the world of investing, the actual path to wealth has almost nothing to do with that spectacular lottery ticket stock pick you see in the movies.
And this is the whole point right here. Your long-term success isn't born from a handful of brilliant genius decisions. No, it comes from the steady, disciplined skill of avoiding major errors. It's about the disasters you manage to sidestep. It's all about what you don't do.
Okay, so to really get this, we need to look at 2 incredibly simple but really powerful questions. Because the question you choose to ask as an investor, well, it defines your entire approach and it will almost certainly determine your results. So on one side, you've got the speculator. Think of them as being on this exhausting treadmill, constantly asking, what happens next? What happens next? It's just an endless, emotionally draining cycle of trying to predict the future. But on the other side, you have the valuator. They ask a much harder but way more powerful question. What is this business actually worth? Now, this takes patience, it takes rational analysis, and it means understanding that a stock's price today and its true underlying value are often 2 completely different things.
And look, the data backs this up in a pretty fascinating way. What you're looking at here is a chart that studies mutual funds. Now, turnover just means how often they're buying and selling stocks, acting like speculators. The funds in that top row, they're the most active, constantly chasing what happens next. And check out their returns. On average, they actually lost money compared to the market. But the funds that were more patient, the valuators with low turnover, they did a whole lot better. It's a really powerful lesson in the cost of all that frantic activity.
So, what happens when an entire market gets caught up in that frantic what happens next mindset? To see the explosive consequences, we need to travel back about 300 years to one of the most infamous financial manias in all of history. Picture this, it's London, 1720, and the city is absolutely buzzing.
There's this company promising unimaginable riches from its exclusive rights to trade with South America. And so people from every single walk of life get this massive fear of missing out. They pour their life savings in, they borrow heavily, and the stock price just completely disconnects from reality and shoots into the stratosphere.
This quote just perfectly captures the feeling of the time, and you will not believe who said it. Sir Isaac Newton. Yep, that Isaac Newton. One of the greatest scientific minds in history got totally swept up in the South Sea bubble and lost a fortune. It's a pretty humbling reminder that crowd madness can overwhelm even the smartest people among us. So how did it all go so spectacularly wrong? Well, it was a perfect storm of classic investing mistakes. People made irrational, emotional decisions, chasing a total fantasy. They poured money into a business they knew absolutely nothing about. They trusted dishonest promoters. The entire scheme was built on a shaky foundation of debt. And most importantly, they completely ignored the fundamental question of value. What is this thing actually worth?
So why do we keep doing this? I mean, why do even brilliant people like Isaac Newton fall into these traps that seem so obvious in hindsight? The answer, it turns out, is hardwired directly into our brains. The psychologist Daniel Kahneman calls this System 1. You can think of it as your lizard brain, that ancient, instinctive gut reaction part of you. It's incredibly fast, it's emotional, and it's great at spotting patterns. And it is the part of your brain that is utterly obsessed with answering, what happens next? And then you've got System 2. This is our slow, deliberate, analytical brain. It's the one that does the hard work, the one that can logically tackle that difficult question, what's it worth? But here's the catch. System 2 is lazy. It takes real conscious effort to fire it up and get it to work.
So just take a moment and be honest with yourself. When you make decisions about your money, which system is really in control? Is it that fast, emotional lizard brain reacting to every piece of news? Or are you deliberately engaging that slow, rational thinker? The answer to that question is everything.
So once you understand this internal battle that's going on, you can choose an investment path that actually fits who you are, your temperament, your skills, and frankly, your interests.
If you genuinely love the puzzle of analyzing businesses and you have the emotional discipline for it, well, active investing might be your game. But if the thought of digging through financial reports makes you want to take a nap, and for most people it does, that is perfectly okay. A passive approach, like owning the entire market through a low-cost index fund, is an incredibly smart and often a much more successful path. So whether you choose the active or passive path, that core principle stays the same. It all comes back to avoiding those big, costly mistakes. So to wrap things up, here are the 5 key regrets you want to make sure you avoid in your investing life.
All right, number 1, letting that emotional lizard brain take the wheel. 2, overconfidence, the trap of thinking you know the future. 3, trusting your hard-earned capital to dishonest or incompetent people. 4, investing in fundamentally broken or dying businesses. And 5, getting so swept up in a fantastic story that you wildly overpay, just like those investors in the South Sea bubble. And that brings us to the final crucial thought. The single most important part of being a successful investor isn't about reading a chart or predicting the next big trend. It's about knowing yourself, your temperament, your biases, and your limitations. True financial wisdom, it begins with self-awareness.
All right, let's just jump right in. We all love to think we're rational, right? Especially with our money. But what if I told you that the very brain that gets you through your day is actually, well, it's hardwired with these little glitches that can make you a terrible investor? Seriously. Today, we're going to pull back the curtain on these silly human tricks our minds play on us, especially when we're trying to make sense of the stock market. You know, the philosopher Bertrand Russell, he absolutely nailed the core problem here. When we're staring into the chaos of the market, our knowledge kind of takes a back seat, and our emotions, they just grab the steering wheel and floor it. The less you actually know about a situation, the more emotional, the hotter you get. And look, here's the bottom line. Getting hot like that, it gets you burned. Those emotional decisions, the panic selling when the market dips, or that euphoric buying right at the top, they're just so costly. It's how we end up buying high and selling low, which is, the exact opposite of the plan. Okay, so let's get into the nitty-gritty. We're going to walk through the most common mental traps our brains set for us. These silly human tricks that are quietly just eating away at our returns. So this first one's a bit of a mouthful, but it's a huge concept from psychology. It's called WYSITI. That stands for what you see is all there is. And it's basically this. Our brains are kind of lazy. They'd much rather make a decision based on something that's right in front of our face. Something recent, dramatic, personal. Think about it. A scary news headline or a hot stock tip from your buddy feels way more real than like decades of boring old market statistics. We end up seeing the headline, but we completely miss the history. And that leads us right into our next big vulnerability. Because what's more recent, dramatic, and personal than a good story? We are absolute suckers for a good story. Our brains are just wired for it. But in investing, oh man, that can be a massive, massive trap. This is something called the narrative fallacy. So we see a stock price shoot up, and then we see some news story, and our brain just instantly connects the dots. It writes a neat little story. A happened, so B must have happened. It gives us this cozy feeling that we understand why things are happening. But a lot of the time, we're just seeing a cause where there's only a coincidence. And that false sense of, I got this, it's incredibly dangerous. And then what happens after the fact? Well, our brains play another trick on us. It's called hindsight bias. You know what I'm talking about. We look back at a market crash or some stock that went to the moon and we think, of course, that was so obvious. We kind of rewrite history in our heads, and it makes us wildly overconfident that we can predict the future. We totally forget just how foggy and uncertain things really were back then. And all that overconfidence leads right into another super dangerous trap, confirmation bias. See, once we've bought into a story we like, this company is the next big thing, we basically go on a mission to prove ourselves right. We hunt down all the articles that agree with us and just conveniently ignore the ones that don't. We build this perfect little echo chamber for ourselves, which is the absolute last thing you want when what you really need is the cold, hard truth. So how in the world do you fight this stuff? Well, you have to be deliberate about it. Here's a little battle plan. First, you have to actively seek out the evidence that proves you wrong. Go read the bearish case for your favorite stock. I mean it. Second, invert the story. So if your thesis is that X will happen, force yourself to argue why the opposite of X might happen. And third, find the shadow side. Remember, every single investment, no matter how great it seems, has a potential flaw. Your job is to be the detective and find it. Now, it's not just about stories. Our brains can get seriously tripped up by numbers too, especially when we get fixated on a number that feels important but is actually totally irrelevant. This is a classic bias called anchoring, and the perfect example in investing is getting stuck or anchored to the price you paid for a stock. You know that little voice in your head that says, I just can't sell until I get back to even? Yeah, that's anchoring. The problem is the price you paid is ancient history. It's an relevant number, but your brain is latched onto it and it's stopping you from making a smart decision based on what the stock is actually worth today. So the key here is to consciously shift your anchor. Stop focusing on your purchase price. That's the trap. Instead, focus only on what the business is worth right now. The legendary investor Peter Lynch had a great way of putting it. He said to use mental whiteout on the price you paid or the gains you might have missed. Just erase it, because the only thing that really matters is the opportunity right in front of you today. Okay, so all these biases, they really build up and they lead to the high cost of feelings in investing. Because beyond all the stories and the numbers, you have to understand the market charges you a very, very steep price for certain emotions. And this quote is just a brilliant metaphor for a super common mistake. We are so terrified of a small gain turning into a loss that we sell our winning stocks, our beautiful flowers, way, way too early. But at the same time, we just can't stand to admit we made a mistake, so we cling to our losing stocks, our weeds, just hoping they'll come back to life. We end up pulling the flowers and watering the weeds. It's completely backwards. And this really gets to the heart of the market's hidden price tag. Think about it like this. The market makes you pay for the feelings that feel good. Panic, excitement, the comfort of doing what everyone else is doing. All of that costs you money. But the market pays you for the feelings that are uncomfortable. It rewards you for the sheer boredom of holding on for years. It pays you for the loneliness of having an opinion that no one else agrees with. That is, until you're proven right. And look, that payment for being patient, it isn't just some nice little metaphor. It is a stone-cold mathematical certainty. This is where it gets really, really interesting. Let's look at the actual numbers. Okay, check this out. Imagine we have 4 different investors. They all start with $1,000. They all buy the exact same stock, and it grows at a nice 8% a year for 30 years. Everything's the same, except for one thing: how often they trade. One investor is super active, trading every 6 months. Another trades once a year. The third waits 10 years. And the last one, they buy it and hold on for the full 30 years. Now, before taxes, they all get the same 8% return. But look what happens when reality, I'm talking about taxes, hits. So after 30 years, our hyperactive trader, the one who just couldn't sit still, ends up with about $4,500. Why? Because every single time they sold, they had to pay taxes. And those taxes just kept chipping away at their money, crippling its ability to compound over time. Okay, now look at our patient investor, the one who was, let's be honest, kind of lethargic and did absolutely nothing for 30 years. Their $1,000, it grew to over $8,700. That is nearly double the result of the active trader. And they achieved it simply by fighting that urge to constantly do something. So at the end of the day, the crucial point is this: patience isn't just some nice-sounding virtue. It's a concrete, mathematically proven, profitable strategy. The less you do, the less you fall for these silly human tricks, the more money you are very, very likely to make. It's that simple. And that leaves us with one final question for you. Look, the crowd, the market, even your own brain, they're all screaming for the comfort of action, of good stories, of fitting in. But all the evidence we've just seen shows that the real profit lies in the exact opposite direction. It lies in having the courage to be lonely and the patience to be, well, boring. So let me ask you, are you brave enough to be bored? All right, welcome to The Explainer. Today we are going to tackle something really fundamental, that super fine line between a smart financial move and just a plain old bet. You know, Wall Street loves to call everyone an investor, right? But is that really what's happening? What if you think you're investing, but you're actually speculating, or even worse, just gambling away your money? You know, that famous line could be said on pretty much any trading floor today. The thing is, on Wall Street, and this is the key difference from a casino, most of the people who are gambling have no idea they're doing it. They honestly believe they're making some kind of calculated, strategic move, when in reality, they're just rolling the dice. So that begs the question, right? How can you tell the difference in your own activities? Well, this explainer is designed to give you a really clear framework to answer that exact question for yourself. Okay, let's get into it. So here's the thing. The difference between gambling, speculating, and what we'll call true investing, it's not really about the specific stock you pick or what market you're playing in. It all boils down to how you answer 2 very simple but really powerful questions about your own approach. First up, what's your focus? Is it event-based? You know, are you buying an airline stock just because you heard oil prices might dip? That's a bet on a single trigger. Or is your focus holistic? Are you actually looking at the entire business, analyzing its long-term health and its ability to generate real profits year in and year out? And the second question is all about your research. And you got to be honest with yourself here. Have you done a really thorough, diligent investigation to understand the odds and the actual value? Or are you just running on a hunch, maybe a hot tip from a friend, or just this generalized faith that, things will work out? Okay, so this is where it gets really interesting. When you combine those 2 factors, you get this kind of map of financial behavior. Look up there in the top right corner. A true investment, that requires both a holistic focus and thorough research. No shortcuts. But now, look at that bottom row. If you've done 0 research, it literally doesn't matter what your focus is. You're gambling. End of story. And you see that middle ground? That's speculation. And it can be shrewd or can be totally reckless, all depending on your process. All right, so let's break down what these different identities actually look like in the real world. As we go through them, ask yourself, which one of these sounds a little too familiar? First, we've got the gambler. This person is basically taking a shot in the dark. They have no idea what their odds of success are. And honestly, they're not even trying to find out. They might tell themselves they're speculating on, say, interest rates or some new technology, but without any real grasp of the probabilities, what they're really doing is just crossing their fingers and hoping for the best. So does any of this sound familiar? If you find yourself racing against the clock on these super short timelines, maybe using leverage, borrowed money, or you've got blinders on because you're just so committed to one single story, well, you might be a lot closer to the casino floor than you realize. These are the classic red flags of unintentional gambling.
Okay, now let's flip that on its head. Contrast that with the definition of a true investor from the master himself, Benjamin Graham. Just listen to the words he uses: thorough analysis, safety of principle, and adequate return. See, it's methodical, it's researched, and it's patient. It is the absolute polar opposite of just acting on a whim. And this number right here, wow, it just brilliantly illustrates the trend we're seeing. The average time someone holds a stock has absolutely plummeted. It went from about 7 years back in 1960 to just 4 months today. That's a massive cultural shift away from long-term holistic investing and straight into the world of short-term event-based thinking. All right, now we get to what might be the most treacherous game of all. It's not speculating on a business. It's speculating on what other people are thinking. This is a game of psychology, not business fundamentals. This is the whole idea behind price momentum. It's the belief that a stock that's going up will just keep going up. Why? Simply because other people will see it rising and decide they have to buy in too. See, you're not betting on the company anymore. You're betting on the psychology of the crowd. And to really get a feel for how tricky this is, let's play a little game. Imagine everyone listening right now picks a number between 0 and 100. The winner is whoever's guess is closest to half of the average of all the guesses. So, take a second. What's your first instinct? What number do you pick? Well, a lot of people will just go with 50, right? It's the random middle point. But that's not really thinking through the rules of the game. Let's call that zero-level thinking, the most basic guess. But then, maybe you start to think a little deeper. You think, okay, if a bunch of people just pick 50, the average will be about 50, and half of that is 25. So you pick 25. This is first-level thinking. You're now one step ahead of the most obvious move. But wait, what if you assume everyone else is just as smart as you are? If they're all going to pick 25, then you need to pick half of their average. So you'd pick something around 12 or 13. Now you're at second-level thinking. You're trying to outguess the people who are already trying to outguess everyone else. Now, a pure mathematician would take this all the way. They'd say, well, if you keep iterating this logic, half of 12 is 6, half of 6 is 3, and so on, the final purely logical endpoint is 0. But here's the crazy twist. In the real world, 0 never wins this game. And why is that? Because the crowd almost never thinks all the way to the logical conclusion. And this is the crucial takeaway. Winning this game isn't about being the most logical person in the room. It's about accurately predicting the imperfect logic of the crowd. You just have to be 1, maybe 2 steps ahead of the average player. And that, my friends, is a fickle, incredibly dangerous, and often unwinnable game to be playing with your real money. Okay, so with all these different traps and distinctions in mind, how do you actually make sure you stay on the right path? Well, let's move into our final section, and I'll show you how all of this builds to a practical tool you can use every single time you think about making a move. Think of this as your personal investing compass. Before you pull the trigger on any financial move, you have to ask yourself these 4 questions. 1, is my focus on the entire business over the long haul? 2, have I done enough real research to feel certain about my conclusions? 3, is my capital actually safe here? And 4, is the potential return I'm looking at truly adequate? If you can't give a confident yes to all 4 of those, well, you might be drifting away from investing and right into the waters of speculation or even outright gambling. Look, this whole framework isn't just some abstract theory. It's meant to be a mirror. So I want you to take a really honest look at your own financial activities. Analyze your focus. Be real about your level of research. After going through all this, you should be able to answer that big question for yourself. Am I a gambler, a speculator, or a true investor? And you know what? The answer just might surprise you. Welcome to The Explainer. Today, we're going to break down the mindset of the world's best investors. And I'll tell you right now, it is not what you think. So forget the Hollywood stereotypes, because we're about to go deep into the counterintuitive traits that actually build lasting wealth.
Okay, let's dive right in with this famous quote from John Steinbeck. It paints this kind of cynical, but let's be honest, pretty familiar picture of what it takes to get ahead, right? This idea that to win, you've got to be ruthless. It's a really powerful image, and it's one that has shaped how we see success for a long, long time. And that really brings us to the big question for this explainer. Is that ruthless image actually true? Especially when we're talking about the super complex long-term game of investing? Well, we are going to challenge that idea head on. To get to the truth, we first have to get clear on who we're actually talking about. Because, not all players in the market are created equal. We throw around words like investor and speculator all the time, but they represent fundamentally different psychologies. Now, this table shows a really stark contrast. I mean, look at this. On one end, you've got the speculator, who's basically surfing short-term trends and relying heavily on luck. On the other end, the entrepreneur, making one huge focused bet. But right there in the middle, that's our focus today, the value investor. And notice their approach to luck? It's not about hoping for it, it's about reducing it through diversification. And their time horizon? We're not talking days or months, we're talking years, maybe even a lifetime. And this idea just illustrates the investor's mindset perfectly. It's a thought experiment from Warren Buffett. What if you only got to make 20 investments in your entire life? All of a sudden, every single decision becomes incredibly important. This concept forces you to have extreme patience and make sure you only commit to your absolute best, most well-researched ideas. It's literally the polar opposite of rapid-fire trading. So, let's get into the real core of this and see how all this builds into a really unique psychological profile. We're about to unpack the mental toolkit that separates the best from the rest. And spoiler alert, it has nothing to do with being the loudest person in the room. So the first key trait is something psychologists call trained intuition. Now hold on, this is not about trusting your gut in the way we usually hear about. In fact, it's the total opposite. It's about developing a deep, logical framework so you can recognize patterns, understand abstract stuff, and think systematically about the future. It's reason that's been sharpened by experience. So here's the crucial point, the real dividing line, your emotional response. A speculator might actually do well by being super sensitive to market moods, riding those big waves of fear and greed. But a true investor, they work hard to cultivate a kind of stoic detachment. Now, this doesn't mean they're emotionless robots. It means they feel the exact same fear as everyone else, but they've trained themselves not to act on those feelings. They let reason, not emotion, drive the bus. This quote just nails it, doesn't it? The entire game of value investing is about figuring out what the rest of the crowd has missed or totally misunderstood. I mean, if you're thinking the same way as everybody else, you can only ever get average results. The biggest prizes? They're reserved for those who have the courage to be a contrarian and be right. So how do you actually build this independent mindset? Well, the source breaks it down into 3 key steps. First, it starts with being a curious skeptic. So read everything, but always ask why. Second, you have to build what the author calls a crap detector, a really powerful internal filter to just toss out all the noise and misinformation. And finally, and this is probably the hardest part, you have to have the psychological strength to stand alone, knowing that your best ideas might make you look foolish to everyone else at first. And this idea of discipline, well, it looks completely different depending on your approach. For a speculator, discipline means acting fast, selling the second a rule is broken. But for an investor, discipline is often the incredible strength it takes to do absolutely nothing. It's having the patience to sit on your hands for months, maybe even years, just waiting for one of those rare punch card opportunities. Okay, now let's talk about failure. From the time we're kids, we're taught that success means getting an A+, a perfect score. But in the stock market, that is a dangerous illusion. So what does a passing grade actually look like for the pros? I promise you, the answer is probably not what you think. 55%. That's it. Just let that sink in for a second. The absolute best investors in the world are wrong almost half the time. The source author has this brilliant phrase for it. He calls it the daily mosquito bite of failure. Learning to live with that constant low-grade feeling of being wrong isn't just a skill. It's a non-negotiable requirement for survival. And this is exactly why humility is so critical. It's the only way to endure being wrong 45% of the time without blowing up your entire portfolio. So when we put all this together, what is the real right stuff for a successful investor? Well, it's a far cry from that greedy, aggressive caricature we started with. It's something much quieter and a whole lot more resilient. So the crucial takeaway here is this. Successful investing isn't about sharpness or egotism at all. It's a powerful mix of rational analysis, emotional control, and the guts to think for yourself. It's the discipline to wait, the humility to accept you're going to be wrong a lot, which stops you from doubling down on bad ideas, and the grit to be comfortable working with incomplete information day in and day out. So we'll leave you with this final thought. The source text says the market rewards a tolerance for ambiguity most when it's in short supply, which is basically a fancy way of saying when everyone else is panicking. This mindset isn't just for investing. The ability to stay rational and patient and humble in a world of chaos, that's not just a skill, that's a superpower. Today, we're going to be detectives. We're diving into a financial mystery, looking at an investor we'll call Fred. His portfolio? It was packed with popular, brand-name funds, but it was lagging behind the market. By cracking his case, we're going to uncover some of those hidden risks and blind spots that, let's be honest, could be lurking in any of our portfolios.
You know, the philosopher Confucius absolutely nailed it. When it comes to investing, it's what you don't know that can really, truly hurt you. The things we overlook, yeah, those are often the biggest threats to our financial goals. So let's meet our guy, Fred. A few years back, he hired a financial advisor who filled up his account with a bunch of exchange-traded funds, ETFs. But Fred started to notice something was off. His account was actually trailing a basic S&P 500 index fund, even a simple bond index. On paper, his portfolio looked slick and modern, but the results, they just weren't there. Fred knew in his gut that something was wrong, but he couldn't quite put his finger on what it was. So let's put on our detective hats. The clues are all right there, hiding in plain sight in his statements, just waiting for us to find them. Let's start digging. Okay, our first clue comes from the oldest rule in any investigation, right? Follow the money. We have to ask a really simple question. Who's getting paid here, and what are they getting paid for? And this lays out the fundamental problem. Fred's goal was simple, right? Grow his retirement savings. But his advisor's firm, well, they had a very different incentive. See, they charged fees on his total account value, plus they got commissions on every trade. So the more they traded, the more money they made, whether those trades actually helped Fred or not. And that incentive structure led to this pretty shocking number, 8. That's the number of months it took for Fred's advisor to completely sell and repurchase his entire portfolio. Just think about that for a second. His whole investment strategy was being flipped almost twice a year. All that buying and selling was just generating a constant river of fees and commissions, acting like a constant anchor dragging down his returns. All right, let's move on to our second clue. This one's a little more subtle. It's about the power of a really good story. It turns out a lot of Fred's investments were sold to him based on these really compelling narratives that completely masked some deeply, deeply flawed strategies. And this is the critical point. A great story about a hot trend, it feels exciting, right? But if you can't back it up with hard numbers and a solid valuation, you're not really investing, you're just gambling. Let's take this first example from Fred's portfolio. His advisor bought a large cap China ETF to, cash in on China's incredible economic growth. The story was perfect, a rising global superpower. I mean, what could possibly go wrong? Well, this is what went wrong. When you actually pop the hood and look inside this fund, it wasn't a diversified bet on the whole Chinese economy at all. Over half of it, more than 50%, was concentrated in state-owned banks and financial companies. These are not the dynamic, innovative businesses you're picturing. These are institutions that are often forced to lend to other inefficient state-owned companies, putting political goals way ahead of profits. So Fred thought he was buying growth. What he was actually buying was state-controlled banks. And hey, here's another one. An ETF sold on the smartphone boom. The story was simple. Everyone's getting a smartphone. It seemed like a total can't-miss trend. But again, the story was hiding a very messy reality. I mean, the way this ETF was put together was just bizarre. It actually gave bigger weightings to weaker component suppliers than it did to giants like Apple and Samsung. It held huge positions in money-losing companies like BlackBerry. It somehow completely missed some of the biggest players in the world, like Huawei. And it totally ignored the fact that fierce competition was absolutely crushing profit margins for everybody. The story was great. The strategy was a total mess.
Okay, this brings us to our third and final clue, and frankly, the single most dangerous product in Fred's entire account. This is where we see complexity being used not to create value, but to hide an incredible amount of risk. Fred was completely baffled by a product in his portfolio called TVIX. And who can blame him? It's a super complex derivative designed to deliver double the daily return of the VIX, which is basically Wall Street's fear gauge. So in short, it's a bet on short-term market chaos. But here's the terrifying secret. Products like this, the ones that use leverage to juice up daily returns, they have a destructive algorithm baked right into their DNA. They are systematically forced to do the one thing every investor is told never to do: buy high and sell low. Okay, stick with me. Let's just walk through how this poison pill works. We'll use a triple leveraged fund to make it super clear. So imagine the underlying index starts at 100 and drops 25% down to 75. A 3x fund tracking that would plunge 75%. Now, to maintain its 3-to-1 leverage, the fund is forced to sell assets right there at the market bottom. Then, let's say the market rallies 33%, bringing the index right back to 100 where it started. The fund doubles in value, which sounds great, right? But it's doubling from that crushed low point. The result? The index is totally flat, but the leveraged ETF has lost half its value. And this chart just shows the trap perfectly. Look at the black line. That's the index. It just zigs and zags and ends up right back where it started. No harm, no foul. But look at the gray line. That's the leveraged fund. It gets absolutely destroyed by that exact same volatility. This decay, it's not a bug, it's a feature. These are not long-term investments. They are ticking time bombs in a portfolio.
So after seeing this, Fred asked the exact question that you are probably thinking right now. Why on earth would they even invent ETFs like that? It just seems insane.
And here is the cold, hard answer. Wall Street creates these products because they are profitable for Wall Street. The complexity is the whole point. It's designed to confuse investors who get sold a good story without ever understanding the math. This allows sophisticated traders to profit from the predictable built-in decay. So, after digging up the high fees, the broken stories, and the dangerous complexity in Fred's portfolio, what are the lessons for the rest of us? Let's boil all of this down into a simple checklist that every single investor should know. Okay, here's your checklist. First, know your own goals before anything else. Then, always follow the money. Ask who gets paid, how, and why. Next, demand a clear strategy, not just a good story, and always look under the hood to make sure you're getting real diversification. And this is a big one. If you cannot explain an investment to someone in a simple sentence, you should not own it. Avoid complexity and run from any product that forces you into making short-term moves. At the end of the day, Fred's portfolio told a story of high costs, seductive but empty narratives, and really well-hidden dangers. The most important lesson from his entire experience is this: your portfolio is telling a story too. The real question is, after everything we've talked about today, do you know how to read it? Welcome to The Explainer. So today, we're going to break down this really crucial mental model for making better decisions, not just in investing, but, in life. It's all about understanding the huge, powerful difference between what you think you know and what you actually know. Okay, let's just dive right in with this quote because it perfectly sets the stage. This idea that a little bit of overconfidence can be seriously dangerous, it's really at the heart of our whole story today. And that story kicks off with a massive real-world failure. And look, this isn't some abstract theory from a textbook. This is a lesson learned the hard way from one of the biggest financial disasters in recent history, a mistake made by a total expert, someone who thought they were playing in their own backyard. So you've got this guy, right? A seasoned investor. He'd been covering the insurance industry for years. He even had a personal connection inside one of AIG's key divisions, so he felt totally confident he knew the business inside and out. He believed 100% that it was inside his circle of competence. Okay, so here's where the whole thing goes off the rails. Deep inside AIG, there was this hidden risk just lurking. They were selling these things called credit default swaps, which were basically like insurance policies on super complex financial products. The problem? They were treating them like simple car insurance. But instead of insuring thousands of separate cars that might have separate accidents, they were insuring massive, interconnected assets that could all collapse at once. It was literally like insuring every single building in a city against one single catastrophic event. And the result? Well, you're looking at it. a loss of nearly $100 billion for AIG in just a single year. The stock just cratered, down 98%, and the US government had to step in with a massive bailout to stop a total collapse. I mean, an absolute catastrophe. So this just forces you to ask a really critical question, right? How could an expert, a real pro who lived and breathed this stuff, miss something so fundamental? And if he could miss it, what does that say about the rest of us? Well, how does something like that even happen? A lot of the time, the answer is this little mental error that is so easy to fall into, the familiarity trap. And here's the absolute crux of it. See, there's a huge difference between being familiar with something and actually knowing it. Familiarity feels safe. It's knowing of a company like Facebook. You use it, you've heard of it. But real knowledge, that's totally different. That's understanding exactly how it makes money, why customers pick it over the competition, and what its real competitive edge is. It's the difference between guessing what happens next and knowing what it's truly worth. And hey, don't just take my word for it. The data tells the same story. Look at this chart. For over 40 years, if you had just invested in the single biggest, most familiar stock in the market, your returns would have been a pretty meager 3.8%. Compare that to over 10% if you just bought the whole index. Sticking with what's familiar often means you're leaving a ton of performance on the table. Okay, so how do we avoid this trap, right? How do we get honest with ourselves about what we actually know and start operating from a place of real strength? Well, this is where we have to define our circle of competence. And that brings us to the core concept for today, this circle of competence. This idea was made famous by legendary investors like Warren Buffett and Charlie Munger. And it's not about everything you've ever learned in school. It's about that small, specific area where you have genuine, deep expertise, a special skill or a real insight that others don't. And this quote, this is the perfect way to think about it. It just makes the whole thing crystal clear. Your general knowledge is like your thousands of social media contacts. You kind of know who they are, but that's about it. Your circle of competence, that's like your 2 or 3 best friends in the world. It's all about depth and real understanding, not just a wide, shallow pool of facts. So here's a little test you can run, a way to really check the boundaries of your own circle. Pick any company, any topic you think you know well. Can you confidently, and I mean in detail, answer these 5 questions? If you start guessing or you're getting a little vague, well, that's a pretty clear signal that you're probably outside your circle. And you know what? That's totally fine. Because knowing your circle isn't just about what's inside of it. It's about having the wisdom and the humility to identify what is clearly outside of it, and then having the discipline to actually stay away. Let's take biotech, for example. Perfect case study. The story of this company, Dendreon, is a classic. They developed a truly groundbreaking cancer drug, they got FDA approval, and boom, the stock skyrocketed. It looked like a home run. But then reality hit. Manufacturing problems, insurance wouldn't pay, and new competitors came out with drugs that were just easier to use. In the end, this amazing scientific success was a total commercial flop, and the company went bankrupt. For most of us, an industry like this is just a minefield. And hey, let's circle back to where we started, insurance. On the surface, it can seem so boring and simple. But just like we saw with AIG, it can hide these dangerous black boxes of risk. You've got unpredictable human behavior, companies getting tempted to chase risky investments, and the simple fact that what happened in the past doesn't guarantee what's going to happen in the future. It's way more complex than it looks. Okay, so what's the big takeaway here? Let's bring it all together. What's the one lesson that can save you from making your own massive mistake? It really all boils down to this. Wisdom is often about keeping it simple. If you look at an idea or a business and you can't easily figure out how it works and what could go wrong, that is a huge red flag to stay away. You're almost always better off focusing on smaller, simpler, more transparent ideas you can actually wrap your head around, instead of one complex giant with a bunch of hidden risks. You know, at the end of the day, this isn't really just about stocks or investing. In a world where we're just drowning in information, the real superpower is humility. It's knowing the difference between 1,000 acquaintances and 2 true friends. It's having the focus and the discipline to play where you are strongest. So the real question to ask yourself is, what's inside your circle? And what are you brave enough to admit is on the outside?
Welcome to The Explainer. Okay, so if you're an investor, you know the feeling. You are just flooded with economic news all day long. GDP, interest rates, unemployment numbers. It feels like this should be a roadmap to riches, right? But what if that map is actually leading you right off a cliff? Today we are digging into a really powerful and kind of counterintuitive idea. Why betting on the big picture so often goes wrong, and why the real secret to success might just be thinking small.
I mean, it's the billion-dollar question, isn't it? Can you actually beat the market just by watching the news? It seems so simple, so logical. The headlines are screaming about inflation, GDP is up, the Fed is doing something. All the puzzle pieces are right there in front of you. So why then, when you put them all together, is the final picture so often a losing one?
And this quote from our source material just nails the temptation. It says, "It looks easy because a deluge of pertinent information arrives daily." That right there is the siren call of macro investing. It's this powerful belief that you can just surf the economic headlines all the way to massive profits. But, as we're about to find out, those waves can be incredibly treacherous.
All right, so that brings us right into our first section, the siren call of macro. What is it that makes this big-picture, top-down approach just so darn tempting?
Well, on the surface, the logic feels kind of flawless. You've got a 24/7 news cycle just feeding you data nonstop. The potential rewards, they're enormous. If you can call the next big move, you're set. And the markets themselves, stocks, bonds, currencies, they're huge. They're easy to trade. You can move millions of dollars with a tiny deposit. You can bet against the market with almost no hassle. It really looks like the perfect system for making a fortune.
But, and this is the big one, here is the fatal flaw. That straight line you think exists between what the economy is doing and what the stock market is doing, it's surprisingly weak. It's almost an illusion. This broken link is the fundamental crack in the entire macro investing philosophy, and we're about to see just how deep that crack really goes.
Okay, so this leads us to section 2, cracks in the crystal ball. Let's start picking apart why that seemingly perfect setup just falls apart under pressure.
Our source material uses this brilliant analogy for this whole mess, the game of telephone. You remember that from when you were a kid, right? You whisper a phrase to one person, they whisper it to the next, and by the end, the phrase is completely distorted. Well, the exact same thing happens with economic data. By the time a piece of information travels from the real world to the data collectors, to the forecasters, and finally to market prices, it's often becomes something completely different.
And a huge part of this distortion is that the definitions themselves are, well, they're slippery. Get this. During the 2009 financial crisis, some European countries suddenly decided to start including revenue from things like prostitution and illegal drugs in their GDP. Why? To make their debt-to-GDP ratios look better. Now think about that. If the very definition of the economy can be changed on a whim like that, how can you possibly build a reliable investment model on top of it?
And this whole thing points to a really crucial difference in standards. In a hard science like physics, if a prediction fails even once, the theory is in serious trouble. But in macroeconomics, you can have theories with absolutely dreadful track records that just hang around for decades. The standards of proof, they're just not the same.
All right, let's put this to the test with a classic economic belief, one you hear all the time. Cutting taxes makes the economy boom. It feels like a simple rule, right? It's practically become a political mantra. But is it actually true?
Well, the data tells a much, much more complicated story. If you look at the period from 1941 to 1964, the top U.S. tax rate was sky high. We're talking over 90% sometimes. And yet the economy grew at a blistering 4.6%. Now compare that to the 1980s when the top rate was slashed all the way down to 28%. The economy grew at 3.4%. Still good, but significantly slower than the high tax era. Now, this doesn't prove that high taxes are better, but it absolutely shatters that simple, neat idea that cutting taxes is a guaranteed ticket to an economic boom.
You know, relying on these simple but flawed stories isn't just an academic mistake. It can be financially devastating. And that brings us to a really powerful cautionary tale from the author of our source material. He calls it my $40,000 trading mistake.
It all started with just $1,500. That was his initial margin. This tiny little deposit that let him control a massive $100,000 treasury bond contract. His bet was simple. The economy was getting stronger, so interest rates had to go up.
And for 3 solid months, he was a genius. The market went his way, he kept rolling his profits into more and more contracts, just pyramiding his winnings.
And at his peak, he had turned that initial $1,500 into over $40,000, which was more than his entire annual salary at the time. He thought he'd cracked the code. And then, in less than 1 month, it was all gone. Zero. The economy, by the way, was still strong, just like he predicted. But for reasons no one could explain, interest rates tumbled, moving in the exact opposite direction of his bet. And everything he'd made just vanished into thin air.
And listen, here's the most important part of that whole story. It wasn't just about losing the money. It was that he had no idea why. Was his logic wrong from the start? Did he miss some critical piece of data? Who knows? And that is the ultimate danger of macro investing. You can't learn from your mistakes if you can't even figure out what your mistakes were.
Now, if you're thinking, okay, that's just one guy's bad luck, I want you to consider this. The man who literally invented macroeconomics couldn't make money doing it. Which brings us to section 4. Even Keynes couldn't do it. That's right, John Maynard Keynes, the father of modern macroeconomics. He tried to invest based on his own grand theories of the economy, and guess what? He got wiped out, twice. In 1920, for example, he was completely bankrupted after betting against the German mark, only to watch it unexpectedly rally and crush him.
After years of trying and failing, even Keynes himself had to admit his big-picture approach just wasn't working. He wrote, and I quote, "We have not proved able to take much advantage of a general systematic movement out of and into ordinary shares at different phases of the trade cycle." Basically, he was saying, even I can't successfully time the market using my own theories.
So what did he do? He made a massive pivot. He totally abandoned the top-down, big-picture approach that was failing him. And his new strategy? It was the complete opposite, bottom-up. He stopped trying to predict the entire economy and started analyzing individual, undervalued companies. He started to think small.
And the result of this incredible shift? Keynes went on to beat the market by an average of 6% a year for 2 decades. Now let that sink in for a second. The founder of macroeconomics only became a legendary investor when he stopped using macroeconomics to invest.
So, if the macro approach is a trap, what's the alternative? Well, this brings us to our final section, the power of thinking small. So what does thinking small actually look like in practice? Well, first, you focus on specifics. It's about understanding one company inside and out, instead of the entire global economy. Second, you establish fair value. You figure out what you believe an asset is truly worth, totally separate from all the market noise. Third, and this is a big one, you know what you don't know. It's way easier to see the gaps in your knowledge for a single company than it is for, well, everything. And finally, and maybe most importantly, you expect and you fix your errors. Small bets on single companies create small, fixable mistakes, not the kind of catastrophic wipeouts we've been talking about.
This whole idea really comes down to a fantastic quote from another legendary investor, George Soros, who said, "I'm only rich because I know when I'm wrong." And that's the real power of thinking small. It's not just an investment strategy. It's a framework for intellectual humility. It creates a system where you can actually find your mistakes, admit them, and then fix them. Something that's almost impossible to do when your bet is on the entire chaotic, unpredictable world.
Welcome to The Explainer. You know, we're always told to invest our money globally, right? To fish in a bigger pond. But what happens when that pond has hidden currents you can't see? Today, we are unpacking the real risks of foreign investing, and it's a journey that goes from safe shores to outright fraud, with some really crucial lessons for your wallet along the way. You know, this quote from Confucius is ancient, over 2,000 years old, but wow, it perfectly nails the core idea for any global investor today. The stability and really the integrity of a country's government, that's the foundation for everything. It's the hidden variable that can make your investment soar or just vanish into thin air. Think about it. When you invest at home, you're in your comfort zone. You get the laws, you use one currency, you have a feel for the culture, right? But the second your money crosses a border, all of that just goes out the window. Your intuition, the very thing you rely on, can be completely and dangerously wrong. And look, on the surface, the logic is, well, it's flawless, isn't it? Why fish in a little pond when you've got the whole ocean? More countries, more companies, that has to mean better returns. It feels like such an obvious path to building wealth. But as you're about to see, the data tells a very, very different story. So, let's play a little game. If you had to guess which country has delivered the best stock returns over the last 100 years or so, who would you pick? The logical answer, right, would be the places with that explosive, off-the-charts economic growth, the so-called economic miracles. Well, you might want to hold that thought because the real answer is probably not what you're thinking. And this is where our assumptions just get completely flipped on their head. You look at countries like Japan and Italy, their economies saw incredible growth. Their GDPs went through the roof, but their stock markets, meh, they seriously underperformed. This right here reveals a critical lesson. A booming economy does not automatically mean booming returns for you, the investor. So if it wasn't the fastest growing economies, who were the big winners? Well, it was places like Australia, Sweden, the US, and the UK. So what's the common thread here? It's not explosive growth. It's the strong, predictable rule of law. The single most important factor, it turns out, was having a legal system that actually protects private property. And that's the bottom line. Capital doesn't just chase growth at all costs. It flows where it feels safe. To really see how this stuff plays out in the real world, let's dive into 3 case studies. First up, we're going to visit a familiar shore, the United Kingdom, and we're heading back to the 1980s to see what a safe investment really looks like. Okay, so when Margaret Thatcher's government decided to privatize the water industry, they created what was pretty much a perfect setup for investors. The companies were sold cheap, single-digit PE ratios. They were handed a pile of cash up front. They called it a green dowry to pay for upgrades. And the rules were literally designed to guarantee returns that would beat inflation. It was clear, it was transparent, and it was a well-protected investment. And the results? For what was supposed to be a low-risk, kind of boring business? Absolutely spectacular. The investment roughly tripled in about 7 years. It was a total home run. And it just goes to show you can find incredible value when you combine an attractive price with a familiar, stable legal system. Okay, so strong laws are good. But what happens when you have the rule of law, but the culture is just a completely different animal? Well, that brings us to our second case study, Japan. On paper, it's a safe, developed market. But in reality, it's a place where Western investment logic can get completely lost in translation. See, here in the US and in a lot of Western countries, the game is pretty simple, right? A company's #1 goal is to maximize shareholder value. But in Japan, the mission is often totally different. Things like maintaining social harmony, providing lifetime employment, or just gaining market share for prestige, those can be way more important than squeezing out every last yen of profit. There's this fantastic Japanese proverb that just sums it all up perfectly. The nail that sticks out gets hammered down. Now think about that in a corporate context. A company that's earning too much profit, that's a nail sticking out. They might attract unwanted attention, social pressure, maybe even political pressure. So they actively try to avoid it. It's just a fundamentally different definition of success. So what has this meant for investors? Well, decades of pretty much nothing. Stagnation. Even though Japan is this wealthy, modern, innovative country, its stock market has basically gone nowhere for over 25 years. And that's a huge lesson. The rule of law is essential, but it is not enough. Culture can be this invisible wall between a country's economic success and your actual returns. All right, our last stop on this world tour, this is where things get truly dangerous. This is what happens when you get a foreign culture plus a really murky legal system. We're going to China to dig into the story of Sino Forest, one of the biggest, most spectacular frauds in modern market history. So Sino Forest, this thing was an absolute superstar on the stock market. It was a Chinese company, but it was listed in Canada, and it had the perfect story for the time. It supposedly owned these vast timber forests that were going to fuel China's incredible construction boom. Investors absolutely poured in, and the stock was just a rocket ship, soaring from $1 a share to over $18, making it a multi-billion-dollar company. But here's the thing. The whole story, it turns out, was a complete fantasy. Underneath all that hype, there was this one fundamental question that most investors just totally ignored. What did this company actually own? See, in China, the government owns all the land, and trying to track who has the rights to a forest through this maze of local paper-based systems was basically impossible for an outsider. And when you look back, man, the red flags were just everywhere. The entire business was a total black box. You ask them, who'd you sell your timber to? They'd say, undisclosed agents. Well, who bought it from them? Unknown customers. And then, of course, the ultimate warning sign. The company's own executives started quietly selling off millions and millions of dollars of their own stock. And then, in 2011,
the whole house of cards came tumbling down. And it's all thanks to this small research firm called Muddy Waters. They uncovered this brilliantly simple way to check the company's story. They realized that every Chinese company has to file its real financial statements with a local government regulator. So for the first time ever, they could actually compare the glowing story Sinoforest was telling its foreign investors with the official documents it was filing back home in China. And what they found? Well, it was absolutely mind-blowing. The company told investors it had billions of dollars in timber assets. The government filings? It owned almost nothing. It told investors about soaring revenues and profits. The official record? Barely any business activity at all. Sinoforest hadn't just exaggerated the truth. It had literally invented a multi-billion-dollar company out of thin air. After that bombshell, the end was swift, really swift. In 2012, the company filed for bankruptcy, and the stock went to zero. It was a complete and catastrophic loss, and a brutal lesson in what happens when you invest in a system that you just can't see into and can't verify. Okay, so we've been through the UK, Japan, and China. After all that, what does this mean for you as an investor? How do you take these hard-learned lessons and actually use them to navigate the global markets more safely? Well, it really boils down to these 4 key ideas. Think of this as your personal investment compass. Number 1, prioritize the rule of law. Just like we saw in the UK, your capital is safest where it's protected. 2, understand the cultural context. A great economy like Japan's doesn't do you any good if the culture doesn't actually prioritize shareholder profits. 3, beware of opaque systems. The Sinoforest lesson is devastatingly simple. If you can't verify it, you don't own it. And finally, number 4, and maybe the most important, know what you don't know. Humility is your single greatest asset when you're investing abroad. So I'm going to leave you with one final question to think about. As an investor, what's your biggest risk? Is it the day-to-day wiggles of the stock chart that you can see right there on your screen? Or is it that invisible web of laws, culture, and customs that you can't see at all? Answering that question, that's the key to investing wisely, anywhere in the world. All right, welcome to The Explainer. So, what really makes a company great? It's not just about the money it makes, right? It's about being distinctive. Today, we're going to unpack a powerful framework that helps you spot the businesses that are truly in a league of their own. You know, Amelia Earhart wasn't just a legendary pilot. Her words, right here, are a total masterclass in strategy. Never do things others can do and will do. That is the secret sauce. It's all about finding that one thing you can do that others can't or won't, and then just owning that space. Okay, so that's a great idea, but how do we actually do that? How do we take this amazing quote and turn it into a real, practical tool for finding these game-changing companies? Well, that is exactly what we're here to figure out. So, our journey starts with this really big idea. You have to look at character before you look at strategy. Forget the flashy Super Bowl ads for a second. We've got to look way deeper, at the very DNA of a company. What is it, really, at its core? When you boil it all down, a company's character really comes from 2 things: what makes them uniquely good at something, and how well they manage their money. For today, we're going to laser focus on that first part, what makes them special. That's the key to this whole thing. This slide just nails the difference. Think of it like this. Character is the deep roots of a tree. It's who the company is. It doesn't change. Apple is always about elegant design. Geico is always about being thrifty. That's their character. Strategy, on the other hand, is like the river. It's how they move and adapt. It's what they do, and it's always flowing from that solid, unchanging character. Okay, so now that we've got a handle on character, let's pull out this brilliant tool from the business legend Michael Porter. This is going to give us a super simple map to understand basically any company's strategy. And here's the beauty of it. It all comes down to just 2 choices. First, who are you selling to? Is it a broad market, like everybody? Or is it a narrow, focused niche? And second, how are you going to win? Are you going to have a superior product, or are you going to have the lowest price? That's it. Every single business strategy fits somewhere in that model. And when you put those 2 choices together, you get this beautiful 2x2 grid, the 4 paths to success. I mean, look at Google and Walmart. Both are chasing everyone, right? But Google does it with a superior product, search, and Walmart does it with low prices. Then you drop down to the niche market and you see the exact same split with Monster and Geico. This little grid is our strategic compass. All right, let's make this framework real.
We're going to walk through each of these 4 paths with some legendary companies and see exactly how their unique character helped them absolutely dominate their corner of the world. First up, Google. Their mission wasn't just ambitious, it was kind of insane. They wanted to organize all the world's information and make it universally accessible. Talk about a superior product for a broad market. You can't get any broader than the entire planet. And they don't just talk a big game about innovation, they live it. And check this out. This number, 2,835 patents in just 1 year. That's not for show. Every single one of those patents is another brick in the fortress protecting their superior product, making it almost impossible for anyone else to catch up. That, right there, is how you defend that quadrant. Now let's flip to the other side of that broad market coin, Walmart. Same target audience, everyone, but a totally different weapon. Their whole character is obsessed with one thing, being absolutely ruthless on costs. Every single penny they save in their supply chain is a penny passed on to you. That's their path to total dominance. Okay, let's drop down into the niche markets. Here, we've got Geico. They also compete on price, just like Walmart, but their genius was in not trying to sell to everybody. They found a very specific type of customer and built a business model that was perfect just for them. And here's the secret sauce. Their model was all about subtraction. They started by targeting super safe drivers, government employees. Then they cut out the most expensive part of the old insurance model, the agent on commission. And then they just passed all those savings directly to the customer. It was simple, it was brilliant, and it totally turned the industry on its head. This brings us to the last quadrant on our map. And, the source material points this out, and it's so true. This is often where you find the most mind-blowing, explosive investments. This path combines a one-of-a-kind product with a super-focused, often overlooked market. Which leads us to one of the most unbelievable investment stories of all time. A tiny company called Hansen Naturals and their wild creation, Monster Energy. So they completely ignored Coca-Cola and Pepsi. They went after a specific tribe. Students pulling all-nighters, truckers on long hauls, gamers, you name it. They gave this tribe a product that not only gave them a jolt, but actually tasted better than the competition. And in doing that, they didn't just find customers, they created a cult following. And the results? It is just staggering. A 600-fold return on the stock. That's turning $1,000 into 600,000. That is the kind of explosive power we're talking about when you own a niche with a superior product. So, we've seen the map and we've seen the treasure. What's the big takeaway here? How can you actually use this framework to go find your own hidden gems? So, here's what to remember. First, always start with character. Who is this company at its very core? Second, pull out this 2x2 map. Ask yourself, does the company have a clear path, or are they just kind of stuck in the middle? Third, keep a really close eye on that superior product in a niche box. That's where the magic often happens. And finally, and this one is huge, when you find one of these rare one-of-a-kind companies, hold on tight. In the end, it really all boils down to this one simple truth. The game isn't about being a little bit better than the next guy. It's about being different. It's about finding that one useful thing that no one else is doing and then building a fortress around it. So now the ball's in your court. With this framework in your toolkit, what truly distinctive companies are on your radar? Go out there and find them.
Hey everyone! So if you own a piece of a company, even just one share, its leaders are spending your money. But how can you really tell if they're making smart moves or, just lighting it on fire? Today, we're going to learn exactly how to spot the difference.
I just love this quote from the old school actor George Raft. It's hilarious, but it also kind of hits the nail on the head, right? When a company is sitting on a mountain of cash, there are some really smart ways to spend it, and then there are all the other ways.
And that really is the billion-dollar question, isn't it? You don't have a seat in the boardroom, but that doesn't mean you're in the dark. You can absolutely figure out what's going on. You just have to know where to look.
And that's exactly what this is all about. We're going to become armchair detectives. You don't need a trench coat or a magnifying glass, just a simple, clear method for looking at the evidence.
Okay, so the super fancy business school term for this is capital allocation. But don't let that clunky phrase fool you. All it really means is following the money. Where are the managers pointing the fire hose of cash? Honestly, it's the single best way to judge their skill and see if they're actually looking out for you.
So here's our 3-step method. Super simple, but incredibly powerful.
First, and this is key, you ignore what they say. Forget the slick annual reports and the buzzword-filled press releases. We only care about their actions. Second, we track the money to see where every dollar actually goes. And third, we judge the results. Plain and simple. Did these decisions make money for shareholders or did they destroy it?
To see how this works in the real world, let's crack open a case file. We're going back to the late 1980s to look at the massive rivalry between two tobacco giants, Philip Morris and RJR Nabisco.
You have to understand this was an absolute golden era for tobacco profits. The whole industry was a cash machine. I mean, to put this in perspective, some of these companies were seeing a return on equity of around 50%. Those numbers are just staggering. They were literally drowning in cash.
But, and this is the big twist in our case, while the profits were through the roof, their main business in the US was actually shrinking. As you can see from this chart, cigarette smoking had been on a steep decline for decades. So here's the central mystery. What on earth do you do with all that cash when your primary market is slowly disappearing?
Let's start our investigation with the first set of clues: internal spending. How did they use their cash on stuff like marketing and developing new products?
And right away, you see two completely different strategies. On one side, you have Philip Morris. They were disciplined, laser-focused. They poured all their resources into one global powerhouse, Marlboro. And on the other side, RJR Nabisco. They were just scattered. They splashed their cash thinly across a bunch of smaller brands and flashy marketing gimmicks, like keeping 30 athletes on retainer, or launching the now infamous Joe Camel, which just ended up bringing them a ton of negative attention.
Okay, on to the next piece of evidence: acquisitions and brand new products. This is where companies spend huge chunks of money trying to buy their way into new growth.
But you know, this is a really dangerous game. Buying other companies is incredibly risky. The data is pretty clear on this. Something like 2/3 of the time, these huge, splashy deals just fail to work out the way they're supposed to. The odds are just not in your favor.
And boy, did RJR make a massive bet on a single product. They poured as much as $800 million into developing something called Premier, which was supposed to be a revolutionary, smokeless cigarette. They really thought this was the future.
But the market felt differently. This is a real quote, by the way, from a portfolio manager who actually tried the product. It was a complete disaster. After about a year, and after burning through a colossal amount of cash, RJR had to just pull it from the shelves.
All right, now for our final line of inquiry. How did these companies return cash to the actual owners, the shareholders? This can happen through dividends, or what we're going to focus on, buying back the company's own stock. Now, here's the crucial thing to get about buybacks. They are not automatically good or bad. It all comes down to one simple thing: the price. If a company buys its stock back for what it's really worth, fine. It's a fair deal for everyone. But if it overpays, well, the shareholders who sell their stock make a quick buck at the expense of the long-term loyal shareholders who stick around.
Let's walk through this math because it's so important. Okay, look at step one. A company starts with 10 grand in cash and 100 shares. Pretty simple. Each share's worth $100. Now step two, management goes out and buys back 40 of those shares, but they overpay big time, $160 a pop. So in step three, they've spent $6,400, which leaves only $3,600 in the bank. Okay, here's the final step, the moment of truth. That $3,600 is now divided among the 60 shares that are left. So what's each share worth now? Just $60. For the shareholders who stayed loyal, value is literally taken from them and handed to the people who sold.
Okay, the evidence is all in. We've looked at the marketing, the big bets, the shareholder returns. It is time for the final verdict in the case of Philip Morris versus RJR Nabisco. And when you lay it all out on a scorecard like this, the conclusion is, well, it's not even close. You can see Philip Morris was superior across the board. Focused marketing, better acquisitions, and great returns for shareholders. RJR, on the other hand, was just inferior. Scattered spending, failed bets, and a huge debt load that meant they couldn't reward their owners. It was just a pattern of bad decisions.
And you know, the ultimate judge and jury is always the stock market. And the results here were just dramatic. Over the next decade, the smart capital allocation at Philip Morris paid off big time. Its stock quadrupled. And RJR, their poor decisions were like an anchor on the stock price. It actually ended the decade lower than where it started. A total knockout victory for smart spending.
So the next time you're looking at a company, remember our armchair detective method. Are you going to listen to the slick story that management is telling you in the press release? Or are you going to ignore all that, follow the money, and check the receipts for yourself? The answer could make all the difference.
You know, in those classic old westerns, it's pretty easy to spot the villain, right? They're always the ones in the black hats. But when you get into the world of high finance, well, it's not nearly that simple. Financial crooks, they're more like magicians. They are absolute masters of illusion, experts at making you look over here, while the real action is happening somewhere else entirely.
So, in this world of crazy complex balance sheets and super charismatic CEOs, how in the world do you tell the good guys from the bad guys? That's really the big question we're going to try and answer today. Because in finance, the bad guys almost never wear black hats.
And this line from The Big Short just nails it, doesn't it? The line between a really bad business decision and an actual crime can be incredibly blurry. It's a world filled with all these shades of gray, and learning to tell them apart, that's the key to protecting yourself.
Okay, let's get into it. Here's our game plan. We're going to start by talking about this whole black hat problem. Then I'll show you a really powerful tool for digging into this stuff. We'll use it on some infamous cases, and then we'll wrap up with a practical watch list to help you spot trouble before it's too late.
So, to really start our detective work, we need the right set of tools. And it turns out, criminologists have this amazing framework that helps us see exactly what's going on behind the scenes of a crime. It's called the fraud triangle.
The theory behind it is actually pretty simple, but it is so powerful. It says that for a big financial fraud to happen, 3 very specific things almost always need to be in place. You can think of it like the recipe for a complete financial disaster.
And here they are, the 3 sides of our triangle. First up, you've got pressure. This is some kind of intense need. It could be greed, it could be debt, or it could just be the desperate need to keep up a reputation. Second, there's opportunity. This is a weakness in the system, right? A lack of oversight that lets somebody actually do it. And finally, the third piece, rationalization. This is the story the person tells themselves to make what they're doing seem okay.
All right, theory's great, but let's put it into practice. We're going to take our fraud triangle and apply it to 3 of the most infamous financial blowups you can think of, just to see how these forces worked in the real world.
So our first case starts with just a number, 400 million euros. At his absolute peak, this was the estimated net worth of a guy named Florian Hum, a man who was, well, truly larger than life.
I mean, Hom was the definition of charisma. He's 6'7", a Harvard grad, a former pro basketball player, basically a hero back in his home country of Germany. But that incredible success created this immense pressure to keep delivering these impossible returns. That pressure, mixed with a whole lot of greed, led him to an alleged pump and dump scheme. That's where you basically lie to inflate the value of a stock you own so you can sell it for a huge profit. In his case, he was supposedly doing this with totally worthless penny stocks in his funds before the whole thing just blew up.
Now for a name I think we all know. This quote, it comes from Bernie Madoff himself. He said this just 1 year before his multi-billion-dollar Ponzi scheme, the biggest in history, was finally exposed. I mean, those words are just a chilling reminder of how powerful deception can be.
Madoff's entire crime was all about opportunity. He built a system that had absolutely zero outside checks and balances. His operation was a total black box. You had to be invited to invest. He acted as his own broker, and get this, he hired a tiny one-man accounting firm to audit an operation of his size. It's just unbelievable. And the rationalization? He said he had to cover some early losses to keep his clients from leaving, and that one lie just spiraled out of control for decades.
Our last case file, Enron. At its peak, this company was trading at 70 times its earnings. That is an astronomically high number for what was, at the end of the day, basically an energy company. That number alone should have been a massive red flag that investors were buying into hype, not reality. You know, the thing about Enron is that it wasn't some sudden explosion. It was a really long fuse. The culture of hiding losses and bending the rules started decades before the collapse. Every single step, from covering up an early trading disaster to lobbying for new accounting rules, just opened the door for bigger and bigger deceptions.
And you really can't talk about Enron without talking about its auditor, Arthur Andersen. Their role just shows this massive conflict of interests. For example, look at their work with another company, Waste Management. Andersen was making more than twice as much money from these lucrative consulting jobs as they were from the actual audit. For Enron, those consulting fees were seen as a potential $100 million client. That created a very powerful incentive to just look the other way.
Okay, so we've seen how pressure, opportunity, and rationalization can absolutely destroy fortunes. How do we use that knowledge to protect ourselves? We can actually turn these really hard lessons into a practical checklist. So here are 6 red flags that should make any investor just stop, take a breath, and look a little closer.
First off, be really careful with companies that are heavily in debt or just seem distressed. Why? Because they are under immense pressure to hide the truth. If their bankers or their suppliers knew how bad things really were, the whole thing could be over. So they have this powerful motive to bend the truth, and that makes you, the investor, the last person to find out.
Second, you have to check the auditor. We just saw this with Madoff, right? A tiny, unknown firm auditing a massive, complex business is a gigantic red flag. It creates a massive opportunity for fraud because there's just no credible oversight. You have to ask yourself, why wouldn't they hire a reputable firm? What are they hiding?
Third thing, take a look at the board of directors. If it's just filled with company executives and their buddies, and none of them own much stock themselves, well, who is really looking out for the shareholders? This lack of independent oversight is another wide-open door for bad behavior, because nobody at the top has any real skin in the game.
Number 4, be skeptical of these roll-ups. Those are companies that seem to grow at lightning speed by just constantly buying other businesses. The reason to be wary is that the complexity of all those mergers can be used like a smokescreen to confuse the numbers and hide how poorly the business is actually doing. It is a classic tactic used by pretty much every major accounting scam, from Enron to WorldCom.
Oh yeah, financial firms. They are basically a jackpot for scam artists. Think about it. They handle other people's money, and their accounting is often incredibly complicated and hard to understand. That combination of access and complexity is a dream come true for anyone looking to cheat the system. It makes them really high risk just by their very nature.
And finally, pay attention to geography. Places with really lax regulations, low taxes, and laws that protect assets from creditors, think the Cayman Islands, or even Florida with its Homestead Act, they can be magnets for people looking to avoid accountability. It's not automatic proof of wrongdoing, of course, but it's another piece of the puzzle you should be aware of. So, after going through all of this, what's the real lesson here? How do we put all this together to keep ourselves safe from the next big financial blow-up?
Here's the most important point. There is no magic test for fraud. Avoiding these kinds of disasters isn't about finding some secret formula. It's about having the right temperament. It's about choosing to protect your money over chasing some sketchy moonshot that could disappear overnight.
And maybe we should end on this thought from Hannah Arendt. The biggest financial crimes often don't start with some master villain deciding to be evil. They start with little compromises, with people rationalizing their actions to deal with immense pressure. It's a gradual slide into disaster by people who, at every step, convince themselves they're just doing what's necessary. The black hat, it turns out, is put on one piece at a time. Welcome to The Explainer. All right, today we are going full-on detective. We're opening the case file on one of the biggest mysteries in the business world, accounting fraud. So grab your magnifying glass, because we're about to uncover the secrets some companies really don't want you to find. So let's just jump right in with the big one, the central mystery that stumps so many people. You see a company, and on the surface, everything looks amazing. They're reporting record profits, the news is great, their stock might be soaring, but behind the scenes, they are literally running out of cash. How? How in the world is that even possible?
Okay, so the first clue to solving this whole puzzle, it all comes down to this one simple but incredibly powerful idea, the immense pressure to hit the number. It's this single all-important target that can drive a company to do some pretty desperate things.
And this is where the trouble starts. The number can be anything, really. It might be quarterly earnings per share, or maybe a fancy metric like adjusted EBITDA, which, by the way, is just a way to measure a company's core operating performance. But once that metric becomes the number, the one thing they can't miss, the temptation to fudge the results can be overwhelming. And that's when the so-called creative accounting really begins.
All right, every good detective knows the first rule. You've got to understand the crime scene. And for us, the crime scene is the company's financial statements. Now I know, they might look a little dry, maybe even boring, but I promise you, they are packed with clues, fingerprints, inconsistencies that can lead us straight to the truth.
You've basically got 3 key documents here. Think of them like the 3 main rooms of our crime scene. First, there's the income statement. That's the story the company wants you to hear, all about their glorious profits. Then you've got the balance sheet, which is a snapshot in time. Here's what we own, here's what we owe. But the cash flow statement, that's the one.
That's like the hidden camera footage that shows you where the cash actually went.
And here is the beautiful thing about accounting, and it's our secret weapon. You can't just lie on one of these statements without leaving a trail somewhere else. It's like a fundamental law of financial physics, thanks to something called double-entry accounting. If you invent $1 of profit out of thin air, boof, you also have to invent $1 of an asset on the other side to make it all balance. A lie in one spot always creates a clue in another, and that is the trail we're going to follow.
Okay, so now that we know where to look, let's talk about what we're looking for. It's time to meet the usual suspects. These are the classic moves, the 4 most common ways that companies try to cook the books. You could call these the 4 deadly sins of accounting. Booking sales before a deal is actually done is a big one. Or, hey, why not just make up revenue from scratch? Another classic is to take this year's expenses and just, kick them down the road into the future. But maybe the sneakiest move of all is hiding your debts and obligations way down in the fine print, where you hope nobody ever bothers to look.
Now, this is where it gets super interesting, because sometimes a company can paint a totally misleading picture without technically breaking any rules. Take the oil industry, for instance. Let's say you drill a well and it comes up dry, a total bust. Under one accounting method, called successful efforts, you have to take that loss right away. You admit you failed. But under another perfectly legal method, full cost, you can actually take the cost of that worthless dry hole and call it an asset. It's the exact same result in the real world, but it creates 2 completely different financial stories. Crazy, right?
Okay, enough with the theory. Let's get our hands dirty. Let's dig into some real-life case files to see how these clues actually show up in the wild.
All right, listen up, because this is probably the biggest, most important red flag of them all. If a company is shouting from the rooftops about its amazing profits, but its actual cash balance is shrinking year after year, something is deeply, deeply wrong. You can play games with profits. You can't fake cash. Cash is real. Always, and I mean always, follow the cash.
So let's look at this company, Aloe Healthcare. On paper, they looked great, a perfume distributor reporting millions in profits. But when you looked at their cash flow, whoa, they were just hemorrhaging money. Then you see they went through 3 different auditors in 3 years. That's suspicious. And then, and this is the kicker, just as investigators were closing in, their main warehouse, the one with all the inventory and records, it mysteriously burns to the ground. An accident? The fire department ruled it arson. You just can't make this stuff up.
Okay, clue number 2. Picture this. A company's warehouse is just stuffed to the gills with product nobody seems to be buying. And on top of that, the customers who did buy stuff aren't paying their bills. The pressure is mounting to hit those quarterly sales numbers. So, what do?
This next one is just wild. Back in the 80s, there was a disk drive maker called Miniscribe. They were so desperate to make their sales targets that they literally started shipping bricks. I am not kidding. They would pack actual bricks into boxes, ship them out to distributors so they could book the revenue, and then, after the quarter officially ended, they'd issue a recall for the product. It's one of the most shameless frauds in corporate history.
All right, our third clue isn't about what's on the financial statements, but what's hidden. The biggest dangers are often buried deep in the footnotes, that tiny print nobody wants to read. And that's where you can find billions of dollars in off-the-books debt. Let's take Circuit City as a perfect example. Back in 2008, if you just glanced at their main balance sheet, everything looked fine. They had almost $300 million in cash, not a ton of debt, looked pretty solid. But if you did your homework and read the footnotes, you'd find a ticking time bomb. They had over $5.6 billion in future obligations, mostly from leases on all their stores. Billions in debt that was basically invisible on the main report. And what happened? Just a few months later, they were bankrupt.
So we've looked at the evidence, we've seen the crime scenes. What's the big takeaway here? How do you, as a financial detective, protect yourself from all this?
Okay, let's put it all together. Here is your official detective's toolkit. These are the key red flags to watch out for. Is free cash flow negative, even when profits are positive? Uh-oh. Is their inventory growing way faster than their sales? That's a huge warning sign. Are they changing auditors all the time? Very sketchy. And finally, does the whole business story just not quite make sense? You've got to trust your gut on that one. But that leads us to the single scariest, most important red flag of them all. It's when a company's financial report is massive, pages and pages long, but it is completely incomprehensible. When you read it and you're just more confused than when you started, that is a major problem. Because complexity is the absolute best friend of a fraudster. It is the perfect place to hide.
So when you see that 100-page footnote section, you have to ask yourself, is this company being transparent, or are they just building the perfect hiding spot? And here's the final rule. You don't have to figure it all out. Life is way too short to get lost in a company's financial maze. If you've given it a fair shot and you still can't understand the story they're telling, the smartest move is often to just close the file and walk away.
Welcome to The Explainer, where we dive into big ideas from some pretty fascinating sources. Today, we're going to tackle a huge question. What makes a business truly last? And here's a spoiler. The answer probably isn't what you think. It's not always about explosive growth or being on the cutting edge. Sometimes it's about being, well, kind of boring. All right, let's kick things off with a little puzzle, one that really messes with what we think we know about smart investing. So, picture this. It's the year 1900. You have some money to invest, and you want to set up your great-grandkids for life. You've got two choices. On one hand, you have the railroads. Now, back then, these guys were the absolute titans of the industry. I mean, they made up a wild 63% of the entire U.S. stock market, but everyone could see they were on the way out. On the other hand, you have the exciting new kids on the block, airlines and trucking. They are the future, right? The definition of high growth. So where do you put your money for the next 100 years? And the winner is the railroads. I know, it sounds crazy, but it's true. The old, supposedly obsolete railroad industry was the better bet. Even though they shrank from that massive 63% of the market down to less than 1% today, the stocks actually outperformed their faster-growing, way more glamorous competitors.
So, how on earth is that possible? What was the secret sauce that the railroads had and the high-flying airlines didn't? And, what does this tell us about what really creates value over the super long term?
To crack this puzzle, we've got to look past the flashy stuff like revenue growth. The source material we're drawing from points us to a much more basic idea. See, the real value of a company isn't its stock price. It's all the cash it's going to spit out over its entire life. Just think of it like a money-making machine. Its value is just the grand total of everything that machine produces.
So if it's all about that future cash, how do we get a handle on it? Well, the source suggests that the total value of a business is really made up of 4 key ingredients. And every industry out there, from tech to tobacco, has its own unique recipe.
And here they are. This is our toolkit for solving the mystery. You've got profitability, lifespan, growth, and, this is the big one, certainty. Now, most people get totally obsessed with growth, right? But as we're about to find out, those other 3 are often way, way more important.
Okay, so let's start with how some companies just keep on winning for decades and decades. They become these golden geese, the kind that just keep laying golden eggs year after year.
If you look at the data over the last century, it's wild. The best performing investments, they weren't in the coolest new tech. Nope, they were in industries that meet our simple everyday needs. We're talking tobacco, food, and in the UK, alcohol. These are businesses where customers tend to stick around and the products don't really change all that much. This chart tells such a fascinating story. You take 3 super profitable companies from 1964 and fast forward 50 years. Brown-Forman, the company behind Jack Daniels, didn't just keep its fat profit margins, it actually grew them. IBM, well, it survived the tech wars, but its profits took a hit. And then there's Kodak, had the same high margins as the others, and then just completely cratered.
So why the big difference? Well, think about a company like Procter & Gamble, with brands like Gillette or Tampax. They have this incredible resilience. Their secret is that demand is just so steady and the product changes so slowly that there's no real incentive for a new competitor to come in and try to shake things up. It's just too much work for too little reward.
Okay, so that's one side of the coin. But what about all the exciting, high-flying tech companies? This is where we get to the real heart of the story, the big showdown between explosive growth and predictable certainty. The stories of Kodak and Polaroid are just the perfect cautionary tale. Back in the 70s, these guys were the darlings of Wall Street, the absolute pinnacle of growth stocks, making tons of money. But technology moves fast. First, new competitors chipped away at their business, and then digital photography came along and made their entire industry obsolete. And poof, they were gone.
And I love this quote from Joel Tillinghast's book. It just nails it. We all love those high-tech rock stars for their incredible growth and glamour. But that lifestyle, it doesn't usually come with a long lifespan or much predictability.
In a world that's always changing, you either adapt or you die. Just look at IBM. It's still around because it completely reinvented itself. It went from a hardware company to a software and services company. Xerox and Kodak, they clung to their old technology for too long and got left behind.
Okay, so let's bring it all back to our original puzzle. Now that we've got our 4-part toolkit, profitability, lifespan, growth, and certainty, we can finally see why the slow and steady railroad actually beat the high-flying airline.
The key difference is baked right into the DNA of each industry. Railroads are basically local monopolies. I mean, think about it. Once a company lays tracks from city A to city B, who in their right mind is going to build a second set of tracks right next to it? Nobody. That power gives them incredible certainty and protects the profits for ages.
Airlines are the total opposite. Yeah, amazing growth, right? Everybody started flying. But for any popular route, say New York to LA, a dozen airlines can just jump in and start offering flights. All that competition just leads to brutal price wars that vaporize any potential profits. It's a nightmare for anyone trying to invest for the long haul.
So here's the big takeaway. Real long-term value isn't just about growing fast. It's about having what investors call a moat, a durable, competitive advantage that protects your business from invaders. That moat is what gives you the certainty and the lifespan you need to let profits grow for decades. And the funny thing is, the biggest, baddest moats are often around the most boring-looking castles. And that brings us to a final question to chew on. When you look at the market today, with all of its own high-tech rock stars, what are the railroads of our time? What are those seemingly boring, overlooked businesses that might just have that hidden certainty, that monopoly-like power that could make them the surprise winners of the next 100 years?
Welcome to The Explainer. Today, we're diving into a commodity that has built empires and, well, brought them crashing down: oil. We're going to explore the super high-stakes world of oil investing, a landscape that's really defined by both legendary gushers and, of course, catastrophic slicks.
You know, this quote from the economist Joseph Schumpeter just perfectly sets the stage. I want you to think of the oil industry as capitalism's grandest hotel. The penthouse suites, they're always full, but the names on the door, they change with dizzying speed. Today, we're finding out why. So let's get right into the core challenge here. Because for anyone looking to invest their money, the oil market presents this huge fundamental paradox. And this really frames that conflict perfectly. On one hand, for speculators, oil is this thrilling playground of volatile prices and just huge potential gains. But for a careful, long-term investor, it's a minefield where asset values can be, as one source put it, shockingly ephemeral. I mean, here today, gone tomorrow. To really get a handle on this risk, we need to understand what actually goes into the cost of a single barrel.
It really boils down to 3 core costs. First, you've got to find it, and that's a high-risk game of geology, luck, and drilling a whole lot of empty holes. Second, you have to develop it, which means a massive capital expense for all that infrastructure. And finally, you have to lift it. That's the ongoing operational cost, and it includes some really hefty taxes and royalties. Now, this cost structure is the key to understanding what happens when a promising investment goes horribly, horribly wrong. Which brings us to a high-stakes gamble in Russia.
So our first case study is the cautionary tale of Yukos. In the early 2000s, this Russian oil giant looked like the deal of a lifetime. I mean, the financials were so good, they almost seemed fake.
Okay, get this. The company's price-to-earnings ratio was a jaw-dropping 0.5. Now, what does that mean? It means its entire market price was equal to just 6 months of its profits. In investing, that's practically unheard of. It's just wild.
And as if that wasn't enough, it was literally swimming in cash. By 2002, after paying off every single bit of its debt, the company still held $7 in pure cash for every single share. It was an absolute cash-generating machine.
So, by every financial metric you could look at, Yukos was an absolute steal. It seemed to have it all, right? Immense, tangible oil reserves and an unbelievably cheap stock price. But this is where the story takes a really dark turn. Because in Russia, the numbers on a spreadsheet don't always tell you the whole story.
The speed of this collapse is just staggering. It all started when the CEO, Mikhail Khodorkovsky, publicly challenged the Kremlin on corruption. And the response was swift and it was brutal. A surprise $27 billion tax bill, frozen assets, and then the final blow, its crown jewel subsidiary was auctioned off for a pittance. In less than 2 years, the state had completely dismantled one of the biggest oil companies in the world.
This is a textbook example of what's known as the oil curse. Remember those lifting costs we mentioned? Well, when a government can fund itself entirely through oil royalties, it doesn't need to tax its citizens. And if it doesn't need their tax money, it often doesn't feel the need for their consent, which can really weaken the rule of law. But you know, political risk isn't the only way to get burned. For a totally different kind of disaster, we're going to turn to Brazil.
So, in the early 2000s, Brazil seemed like the polar opposite of Russia. You had a vibrant, growing democracy, and its national oil company, Petrobras, was making one incredible discovery after another.
The excitement at the time was just off the charts. I mean, look at that ratio. For every single barrel of oil Petrobras pumped out of the ground, its geologists were discovering 2 new barrels. This was unheard of. In a mature, slow-growth industry like oil, Petrobras was a legitimate growth stock. The company made these monumental discoveries, fields like Tupi and Libra, holding billions and billions of barrels. They were so massive, they actually reversed the 30-year global decline in finding new oil. The stock price just soared and multiplied tenfold. But while all that black gold was gushing, something really insidious was festering just beneath the surface.
And then the cracks started to appear. First, costs went ballistic. Their break-even price, the price they needed just to not lose money, shot up from around $20 to over $80 a barrel. Protectionist laws forced them to use expensive, less efficient local equipment. To fund it all, their debt just exploded past $100 billion. And then came the knockout blow. Operation Car Wash, a colossal corruption scandal where billions were being skimmed off contracts and funneled to politicians.
You see, Petrobras had this famous nationalistic slogan, "The oil is ours." But the scandal forces you to ask a really pointed question. Who exactly is us? Was it the citizens of Brazil, the shareholders who were taking all the risk, or was it the corrupt politicians and insiders treating the company like their own personal piggy bank?
So these 2 stories show completely different paths to the exact same disaster. Yukos was destroyed from the outside by a raw political power grab. Petrobras, on the other hand, just rotted from the inside because of corruption and mismanagement. The lessons here are stark. The rule of law is absolutely critical. And having great geology, well, it just isn't enough. And this brings us to the big question. How can an investor possibly navigate this minefield?
After seeing those 2 train wrecks, you might think successful oil investing is totally impossible. But, thankfully, the sources we looked at provide a very clear 5-point checklist for survival, the key indicators of safety you should look for.
Okay, this is the investor's survival guide. Number 1, low costs. That is your ultimate defense in a price crash. 2, stable politics. You need a predictable rule of law where contracts are actually honored. 3 and 4 are all about a cheap price, both relative to its assets and its current earnings. And finally, number 5, little to no debt, because debt is the killer in a downturn. A company that checks all 5 of these boxes, well, it dramatically improves its odds of survival.
The source material ends with this really powerful warning, referencing the classic film There Will Be Blood. Because if you just chase the thrill and ignore these fundamental signs of safety, you risk the same fate as its doomed protagonist. You risk finishing with absolutely nothing.
And that leaves us with one final, crucial question. The next time you see a company that looks impossibly cheap on paper, I want you to remember Yukos and Petrobras and ask yourself, what are the hidden, unquantifiable risks that the numbers on the spreadsheet just aren't telling me?
You know, tech investing has this kind of science fiction allure to it, right? It promises to turn a small stake into an absolute fortune, all by backing the next world-changing idea. We all have that dream of finding the next Amazon or Apple. But what if the way we're all trying to find them is just fundamentally flawed? Let's dig into that idea.
Okay, so let's kick things off with this fantastic quote from Jeff Bezos, which at first glance feels completely backward, doesn't it? In an industry that is all about relentless, constant change, he says he looks for the constants. This is our first clue that maybe, just maybe, the secret to navigating the tech world isn't what we think it is.
And that right there leads us to this huge mystery. I mean, tech has created tons of billionaire founders and venture capitalists, but think about it for a second. No public market investor has become a true legend, a Warren Buffett, just by picking tech stocks. So why is that? What is it about this sector that makes it so uniquely difficult to master?
All right, to get to the bottom of this, we've got to bust a few myths first. And the first one is this idea that success in tech investing is all about this one heroic act of finding that single brilliant company before anyone else does. I mean, just look at history. It's totally packed with stories of the wrong people getting rich. Julius Lilienfeld patented the transistor, but it was Bell Labs and Intel that built the empires. Alan Emtage invented the search engine, but it's Google's founders who became household names. And Nikola Tesla, who dreamed up wireless electricity over a century ago, he died broke. The big takeaway here is that having a brilliant invention is often completely separate from having massive financial success.
So, why does this happen? Well, a lot of it comes down to how these markets actually work. Tech isn't a friendly, collaborative space. It's dominated by these incredibly powerful forces like network effects, where a service gets more valuable the more people use it, and these huge economies of scale. What this means is that entire industries tend to collapse around just one or two massive winners, while pretty much everyone else gets left in the dust. It's just a brutal landscape out there.
Okay, let's really dig into the brutal math behind this. Imagine you invest the same amount of money in 100 new tech companies. One of them is this huge 100-bagger success. Amazing. Another one is a big 50x winner. Fantastic. But then you look at the rest of the portfolio. Half the companies basically go nowhere, and the other 48, they go completely bust. You're left holding a whole lot of zeros.
So, after all that chaos, what's your total return on that basket of 100 stocks? You've only doubled your money. Now, doubling your money sounds pretty good, but spread that out over 10 or even 20 years. I mean, that's not great. It's a pretty mediocre outcome. This really shows why just buying a basket of the next big thing is a lot like buying a lottery ticket, where the house always has a massive edge.
All right, that brings us to myth number 2, the assumption that if a company has world-changing, genius-level technology, it's just destined for success. And for this one, we're going to look at maybe the most famous cautionary tale in the entire history of tech, a company that really, once upon a time, had it all. Let's take a trip back in time. We're heading to Xerox's Palo Alto Research Center, or PARC, back in the 1970s. This place was the stuff of legend. Literally, a collection of the brightest minds in computing, all gathered together under one roof.
And you will not believe what they came up with. The modern personal computer. The graphical user interface, the GUI, the mouse, Ethernet networking, email, the laser printer. They didn't just invent a cool product, they basically invented the entire roadmap for personal computing for the next 40 years. It's just insane.
And this next quote, wow, it just says it all. This is supposedly what Bill Gates said to Steve Jobs when they were arguing over who stole ideas from whom. The funny thing is, they both knew the truth. They were both grabbing ideas from their rich neighbor, Xerox, who was basically leaving the front door wide open.
So that just begs the billion-dollar question, right? With all that genius, all that world-changing tech sitting right there in their own lab, why couldn't Xerox actually capitalize on any of it? Well, the answer really boils down to this huge culture clash. It's a textbook example of what we call the innovator's dilemma. The researchers at PARC, they wanted to sell these new, unpolished, revolutionary products. But the Xerox sales team, they were a well-oiled machine trained to do one thing and one thing only, lease reliable copiers and sell toner. That was a business with steady, recurring, high-margin revenue. These new inventions were the total opposite. One-time sales, lower margins. It's wild. The company's own success basically blinded it to the future that it had just invented in its own labs.
Okay, so let's recap. We've seen why just picking inventors is a flawed strategy, and why even having the most brilliant technology isn't enough on its own. So what's the actual reality here? What's the solution? Well, it lies in adopting two very different, almost contradictory ways of thinking at the exact same time.
Okay, so on one hand, you've got to be the futurist. This is the visionary who's always asking what's the next big thing and is focused on growth at any cost. Think about an early-stage startup. And on the other hand, you have to be the financial analyst, totally laser-focused on current profits, minimizing costs, like a stable, mature company. If you only rely on one of these, you're left with a massive, massive blind spot.
You see, a really successful company is basically fighting a war on two fronts, all the time. It has to fight off obsolescence, that's the futurist job, to see what's coming. And it has to fight off competition with a solid financial plan, that's the financial analyst's job. To really last, you absolutely need both.
All right, so how do we take all of this and actually turn it into a practical way of looking at tech companies, something that gets us past all the hype and the noise?
The real key here is to change your goal from just getting lucky to exposing yourself to luck.
And that is a really important difference. This isn't about buying a lottery ticket and hoping for the best. It's about investing in situations where the potential upside from the spectacular winners is so huge that it can mathematically more than cover all the inevitable losses. It's all about stacking the odds in your favor.
So, here's the playbook, the smarter approach. First, you have to adopt both mindsets we just talked about. Be the futurist who can see the incredible potential, but also be the financial analyst who demands a clear path to actually making money. Second, you have to favor businesses that are defensible. Look for what Warren Buffett calls a moat, strong barriers that protect them from competitors. And third, and this is so important, always compare the price to the actual value. It's so easy to get swept up in a great story, but you can never forget what the business is actually worth today.
And that really leaves us with one final big question you should ask yourself. When you look at a tech investment, are you just buying a lottery ticket, a blind bet on some sci-fi future, or are you making a calculated decision to truly expose yourself to luck? And honestly, the difference between those two mindsets, well, that's everything.
You see it in the headlines all the time, right? A massive company, a household name, suddenly goes under. The reasons always sound so complicated. About recession, some new technology, they lost touch with their customers. But what if I told you that in almost every single case, it wasn't the first punch that knocked them out? What if it was a single fatal vulnerability they gave themselves? Well, that's what we're talking about today. It's called the debt-death spiral. And once you understand it, you'll see why so many giants fall. This quote from the tennis legend Martina Navratilova, it hits the nail on the head. Any company can look like a genius when the economy is booming and money is cheap. But that's not the real test. The true test, the thing that separates the survivors from a historical footnote, is how they perform when things get tough. It's not about how you play in the sunshine. It's about whether you can survive the storm. And you know what that storm almost always is? It's debt. Way too much debt. Sure, a recession or a new competitor might get the trouble started, but it's the mountain of debt that turns a manageable problem into an absolute catastrophe. See, when cash flow dries up, these overloaded companies enter a death spiral. They're forced to sell their best assets for pennies on the dollar just to make payroll. The key thing to remember is this: debt is almost always the trigger for that final dramatic collapse. All right, to really see how this plays out in the real world, let's look at our first cautionary tale, the Tribune Company. We're talking about a media giant that, for decades, looked completely and utterly invincible. To really get what happened, you have to understand the world they lived in. For most of the 20th century, owning a major newspaper was like having a license to print money. I mean, they were total cash cows. The revenue was stable, it was predictable, and that made them look like the absolute perfect target for something called a leveraged buyout. That's where you borrow a ton of money to buy a company, and then you use the company's own profits to pay back the loan. And in 2007, that is exactly what happened. In one massive deal, the Tribune Company was taken private, and in the process, it was saddled with over $11 billion in debt. Just let that number sink in. $11 billion. This chart shows you just how insane that was. Okay, so investors use this metric, debt to EBITDA, to gauge risk. It's basically how much a company owes compared to how much it earns. And as you can see here, the rule of thumb is that anything over 4 times earnings is the scary level. That's the danger zone. The Tribune, they were at a jaw-dropping 9x. They weren't just in the danger zone, they were playing with fire in a warehouse full of dynamite. And look how fast it all went wrong. The deal closes in 2007. Just 1 year later, the recession hits, online competition explodes, and all that advertising revenue that was supposed to pay off the debt, it just vanished. By December of 2008, the company files for bankruptcy. 1 year. That's all it took for $11 billion in debt to take down a 160-year-old institution. So you have to ask yourself, how on earth does a disaster like this even happen? It's not just bad luck. It turns out, most of these failures happen when companies break 2 fundamental rules of financial survival. We'll call them the matching principles. And here they are, the 2 big ones. On the left, you've got duration matching, which is all about time. And on the right, you've got risk matching, which is about the nature of what you're buying. Get one of these wrong and you're in for a bad time. Get both of them wrong and you are headed for a fall. Let's start with the duration matching principle. It's actually just common sense. You wouldn't take out a 1-year loan to buy a house you plan on living in for 30 years, right? That would be crazy. The same logic applies to a business. If you've got a long-term asset, like a factory or a brand that took decades to build, you need to fund it with capital that isn't due tomorrow. That means shareholder money or really long-term bonds.
Then there's the risk matching principle. This one is just as important. Think about it. People who lend you money, bondholders, they're risk averse. They just want their money back with some interest. Period. Shareholders, on the other hand, they're the risk takers. So if you're buying something risky and uncertain, like goodwill, which is basically just paying for a company's reputation, you should fund it with risk-taking equity, not risk-averse debt. Using borrowed money to make a bet on the future is just asking for trouble.
Now, the Trimpian story wasn't some fluke. This pattern of ignoring these matching principles and then getting absolutely crushed by debt, it happens over and over and over again, especially in certain types of industries. We're talking about a gallery of the usual suspects here. Asset-heavy industries like airlines, shipping, and real estate. Now, on the surface, they look great to lenders because they have all these massive physical assets for collateral. But here's the catch. They are also incredibly cyclical. And when that cycle turns down, the value of all that collateral can just evaporate, usually right when the debt payments are due. Let's take NCI Building. This was a roll-up, a company that just grows by buying smaller companies, usually with debt. So they violated both matching principles right out of the gate. But even worse, they used something called bullet maturity debt, which means a huge single payment was due all at once. When the market turned, that payment acted like a literal bullet, wiping out 98% of the company's stock value.
Or how about American Airlines parent company, AMR? I mean, airlines are the textbook definition of asset-heavy and cyclical. By the time they went bankrupt in 2011, they'd only been profitable in 2 of the previous 10 years. Their liabilities, what they owed, were so massive that they had completely wiped out the value of all their assets, and then some. This left them with a negative net worth of over $7 billion. They were literally worth less than nothing. But maybe the ultimate example, the final boss of all of these cautionary tales, is General Motors. Before its bankruptcy in 2009, its balance sheet was this sprawling, indecipherable mess. It was so complicated that it was basically hiding the scale of the disaster in plain sight. This chart gives you a pretty good idea. The vast majority of the company was just liabilities. Huge pension obligations, enormous debts, and its massive financing arm, GMAC, which had been making tons of risky subprime loans. And that tiny little sliver right there for shareholder equity, that's supposed to be the cushion, the shock absorber. And as you can see, there was basically nothing there. So when the 2008 crisis hit, there was simply nothing to absorb the blow. So after all these stories of collapse, you're probably asking, is there another way? Is there a path to corporate longevity that actually avoids this debt-death spiral? Well, it turns out there is. And the answer might be found by looking at companies that have survived not just for decades, but for centuries. For a lesson in survival, we can look to Japan. This is pretty incredible. Of all the companies in the world founded before the year 1700 that are still operating today, over half of them are in Japan. They have to be doing something right. And here's the difference. The aggressive, high-leverage model that's so common in the West is all about maximizing short-term returns. It sees companies as assets to be bought and sold. The Okinawa diet model, on the other hand, prioritizes one thing above all else: survival. These companies often hold more cash than debt. They don't see the business as a tradable asset. They see it as a long-term community of employees, suppliers, and customers. So the keys to longevity are actually pretty clear. First and foremost, you have to respect the matching principles we just talked about. Second, you maintain a large cash cushion for the downturns that you know are coming. Third, if you have to take on debt, make sure its repayment schedule is manageable, even in a recession. And finally, stay focused. The oldest companies tend to master one thing instead of diversifying into a bunch of areas they don't really understand. And this all brings us to one final, really clarifying question. The pursuit of rapid, debt-fueled growth, that's a sprint. It's exciting, for sure, but it comes with a really high risk of a spectacular flameout. The path of financial prudence and focusing on survival, that's a marathon. It might not be as flashy, but it's how you make sure you're still around to cross the finish line, maybe even centuries later.
All right, welcome to The Explainer. You know, when it comes to investing, you're just bombarded with noise, right? Financial news, analyst ratings, market hype, it's everywhere. So today, we're going to cut through all of that. We're on a hunt for one simple, powerful number that can help us make much smarter decisions.
So let me just ask you this. What if there was a secret number hiding right there in plain sight that could give you a genuine edge?
a single metric that has, historically, pointed the way to better returns. Well, believe it or not, there just might be one.
And that number is something called the earnings yield. Now, I bet you've heard of its more famous cousin, the PE ratio, right? The price-to-earnings ratio. Well, the earnings yield is simply that, but flipped upside down. And that one simple flip, well, it can change everything about how we look for value in the market.
Okay, so what is it officially? It's just a company's earnings per share divided by its price per share. But forget the textbook definition for a second. A much, much better way to think about it is this. What's my potential rate of return if the company's earnings just stay the same? It turns a stock price from some abstract number into something that feels a lot more tangible, kind of like the interest rate you'd get on a bond.
Here's an even simpler way to look at it. Think of the earnings yield as the price tag for $1 of a company's profits. A high earnings yield means you're getting a low price tag, and a low price tag, well, that could be a serious bargain.
So this all leads to the big question, right? The theory sounds great. Buy stocks with a high earnings yield, the cheap ones, and you should do well. But does it actually work in the real world? Or is it just a nice idea that falls apart in practice? Let's dig into the data. All right, check this out. This table is based on some legendary data from Dartmouth professor Kenneth French. He basically sorted all stocks into 10 buckets, from the most expensive, that's the low 10 with the lowest earnings yield, all the way to the cheapest, the high 10. Now don't worry too much about equal weighted versus value weighted. The big picture is what matters, and man, that picture is crystal clear. Just look at the trend as you go down the table to the cheaper stocks. The returns just keep getting higher. And we are not talking about a small difference here. This is huge. Between 1951 and 2015, the absolute cheapest group of stocks more than doubled the annual return of the most expensive ones, 18.6% versus 9.1%. That's just staggering. So case closed, right? Buy cheap, get rich. Well, hold on. It's never that simple. You know, Warren Buffett has a great quote for this. He said, "Forecasts may tell you a great deal about the forecaster, they tell you nothing about the future." And that's the reality check we need. Just because something looks cheap doesn't automatically mean it's a good investment. And that brings us to a really important twist in this whole story.
And to really get this twist, we've got to talk about the perfect cautionary tale. I call it the Walmart paradox. It's the story of how one of the greatest businesses on the planet became a total dud of a stock for more than a decade.
Okay, let's set the scene. It's December 1999. The dot-com bubble is in full swing. And Walmart is king. It's seen as this unstoppable blue-chip growth machine, and investors were willing to pay any price for it. The stock was trading at a PE ratio of 55. A PE of 55. That's an earnings yield of just 1.8%. Think about that. You're paying a massive price for a tiny potential return.
But here's the crazy part, the paradox. The people who were bullish on the business were totally right. For the next 13 years, Walmart kept on crushing it. Its earnings grew by a massive 11.3% a year. So the business was fantastic, but the stock went absolutely nowhere. For 13 years, if you bought at that peak, you made zero in capital gains. How's that even possible?
Well, the answer is a powerful concept in finance called mean reversion. Basically, things tend to go back to their average. And that PE ratio of 55, that was way, way above average. So over the next decade, even as Walmart's earnings were going up, its PE ratio was crashing down, from 55 all the way back to a normal-ish 14. And that collapse in the price tag, it completely canceled out all of that amazing business growth. It's such a critical lesson. The price you pay matters a lot.
Okay, so that's a single stock story. But what if we zoom out? Does this idea apply to the entire market? Absolutely. In fact, the starting price of the S&P 500 is one of the best clues we have about its likely returns over the next decade.
And the data on this is just undeniable. When the market has been historically cheap, we're talking in the bottom 20% for valuation, the average real return after inflation over the next 10 years has been a fantastic 11.6%. But what if you buy in when the market is super expensive, in the top 20% for valuation, like during the dot-com bubble? Well, your average 10-year return plummets to just 4.4%. That's a huge difference. The starting line really does determine a lot about the race.
So this raises a question. How do we get a good, reliable read on whether the market is cheap or expensive? I mean, a single year's earnings can be all over the place because of booms and busts, right? Well, that's where the CAPE ratio comes in. It was developed by economist Robert Shiller,
And it's a genius idea. It just smooths everything out by averaging earnings over a whole 10-year business cycle. It gives you a much better signal.
And hey, don't think this is just some American thing. The idea of not overpaying for stuff, that's like a universal law of investing. It works pretty much everywhere. Take a look at this. A study tracked 16 different countries, starting way back in 1980. It looked at their PE ratios then, and then tracked their returns for the next 35 years. And the results are just, wow. Japan, which was the priciest market back then, delivered some of the worst returns. And the cheapest markets, like Sweden, they ended up being some of the absolute best performers. It's the same story, again and again.
Okay, so we've learned two huge things. 1, buying cheap stuff generally works. 2, buying a great business at a crazy high price like Walmart can be a disaster. So how do we put those two ideas together? Let's build a practical checklist.
All right, here are 4 steps you can use to think more clearly about valuations. First, start with that high earnings yield, the low PE, but you got to be a little skeptical. Make sure those earnings on paper are actually turning into real cash. Cash is king. Second, smooth things out. Average the earnings over 10 years, just like the CAPE ratio does. That way, you won't get tricked by one good year or one bad one. Third, you've got to apply the Walmart test. Ask yourself, does the future growth needed to make this price make sense, or is it pure fantasy? It's a really important sanity check. And finally, number 4, you have to look past the numbers. A company might look cheap, but if it's got a mountain of debt or its entire industry is disappearing, that's not a bargain, that's a trap. You want to find companies that have a real durable advantage.
And that really brings us to the heart of it all. See, the real goal isn't just to find a statistically cheap stock. Anyone can run a screen for low PE ratios. The real art is finding a high-quality, growing business at a reasonable price. And that means you have to balance the hard numbers with the story of the company itself. So the question for you to think about is, how do you find that balance?
So what if I told you that a company could be wildly profitable and at the exact same time be losing millions of dollars? It sounds impossible, right? But believe me, it happens every single day in the world of corporate earnings. Today, we're going to pull back the curtain on this earnings shell game to show you exactly how it works, and more importantly, how you can protect yourself from it. You know, this old joke, it really just nails it, doesn't it? It's a perfect, sharp reminder that financial reports aren't always just about the math. A lot of the time, they're about storytelling. And as we're about to see, some companies are incredibly creative storytellers, spinning these amazing tales that have very little to do with reality.
And right there, that creates a massive problem for us as investors. I mean, a company's stock price at the end of the day is driven by its earnings. But if you can't trust the earnings number they're giving you, how can you possibly figure out what a company is truly worth? Answering this one question is absolutely the key to successful investing.
Okay, to really get to the bottom of this, we need to understand the 2 different versions of the truth that you're going to see. On one side, you've got GAAP earnings. Now think of this as the photograph. It's a picture taken with a standardized lens, following really strict rules, and it's designed to show you what's actually there. But then you have adjusted earnings. This is the painting. This is the company's own artistic interpretation of reality, where they can conveniently paint over all the ugly parts to show you a much, much more flattering picture of how they're doing. To really see just how dangerous this painting can be, and to be clear, this kind of thing happens across all sorts of industries, we're going to zoom in on one of the most infamous examples out there. For a while, Valeant Pharmaceuticals wasn't just another company. It was a Wall Street masterpiece, a true miracle of modern finance. I mean, just look at this timeline. This shows the incredible story Valeant was telling the world, using their own special metric they called cash earnings per share. The growth was just breathtaking. From just over $1 in 2008 to more than $8 a share by 2014. This was the beautiful painting they presented, a masterpiece of nonstop growth, and investors could not get enough of it. And here's the result of that masterpiece. Wow! Investors bought the story hook, line, and sinker. The stock price just exploded, skyrocketing from only $7 to a peak over $260 a share. For a while there, it really seemed like the painting was way more valuable than reality. But here's the thing. While everyone was admiring that beautiful painting, there was a completely different story hiding in plain sight, buried deep in the fine print of their official financial reports. And this story? It wasn't a masterpiece.
It was a horror show. So here it is, the photograph versus the painting, side by side. On the left, you've got that amazing story of growing cash earnings. And on the right, you have the ugly reality of GAAP showing loss after loss after loss. I mean, these two stories don't just differ a little bit, they're describing two completely different universes.
So this brings us to the million-dollar question, right? How is this even possible? How can a single company be both a runaway success story and a financial disaster at the exact same time? It's time to decode this magic trick.
Well, the magic was really just a simple but super powerful playbook of these so-called adjustments. In a nutshell, Valeant just asked investors to close their eyes and pretend that billions of dollars in very real, cash-draining costs just didn't exist.
It was a simple four-step process. They'd start with their real GAAP loss, and then they'd just start adding back all these expenses as if they never happened. The actual cash it cost them to restructure and lay people off, poof, gone. The cost of their patents, their most important assets losing value over time, vanished into thin air. Paying their employees with stock, which is a very real expense. Let's just pretend it didn't happen. The fees on their billions of dollars in debt, no problem. And just like that, a huge loss magically transformed into a beautiful profit.
Let's just zoom in on one of these. Amortization. The easiest way to think about it is like this. If you own a car, it loses value every year, right? That's depreciation. Well, for a drug company, their patents are their most valuable assets, and they also lose value every single year as they get closer to expiring. That's amortization. Valeant was basically asking investors to pretend their most important assets weren't aging. And in 2015 alone, this one little trick added almost $2.5 billion to their adjusted profit.
And on top of all these accounting games, Valeant was a master of the corporate shell game. They were constantly changing how they reported their results, shuffling business units around from one bucket to another. It made it basically impossible for investors to track the performance of any single part of the company. You'd ask, hey, is their core dermatology business actually growing? Or are they just hiding its decline with the new acquisition? You couldn't tell. And you know what? That was exactly the point.
For years, investors were just mesmerized by the painting. But you can only pretend for so long. Reality has a funny way of asserting itself. Eventually, the ugly truth of that photograph started to bleed right through the canvas. The masterpiece was beginning to completely unravel.
The big catalyst was a scandal involving a specialty pharmacy called Philidor. It turned out that Valeant secretly controlled Philidor and was using it to aggressively push its own expensive drugs, basically creating sales that looked real on paper but were totally unsustainable. And once this whole scheme was exposed, the entire structure collapsed, and the real sales numbers just cratered. And while Valeant was busy painting this picture of phantom profits, a very real monster was growing in the basement: debt. To fuel this endless acquisition spree, the company borrowed just staggering amounts of money, going from $300 million to over $30 billion in debt in just 6 years. That's a 100-fold increase. This was one number they couldn't just wish away with an adjustment.
And this, well, this was the brutal result for everyone who believed the story. When that beautiful painting finally dissolved, the stock collapsed by over 90%. Billions and billions of dollars in shareholder wealth, all built on a foundation of accounting tricks, just vanished.
Okay, the Valeant story is a harsh one, but it's an incredibly valuable lesson. So how can you use it to protect yourself? What are the key takeaways that can help you spot the next earnings shell game before it's too late?
First off, instead of relying on the company's painted numbers, try to focus on a metric you can calculate yourself called owner earnings. It's actually pretty simple. You start with the cash the company actually generated from its operations, not its accounting profit, but the real cash from the cash flow statement. Then you subtract the money it had to spend on things like new factories and equipment just to keep the business humming along. What's left over is the true cash profit available to the owners. And trust me, it's much, much harder to fake cash. So here are 3 critical red flags you should always watch for. First, if a company's adjusted earnings are consistently and dramatically higher than its real GAAP earnings, your alarm bell should be going off. Second, always compare the income statement to the cash flow statement. If a company is claiming it's wildly profitable, but it isn't actually generating any cash, something is very wrong. And third, be extra careful with companies that are constantly buying other companies and have a balance sheet that's just loaded with these intangible assets. That was Valeant's exact playbook.
Ultimately, it all comes down to this one question. The next time you look at a company's results, just stop and ask yourself, is this a standardized, rules-based photograph of reality,
Or is it a carefully crafted painting designed to show me exactly what the artist wants me to see? Knowing the difference can save you from believing in a masterpiece that's destined to fade.
Today, we're diving deep into a question that sits at the very heart of investing. How in the world do you figure out what something is actually worth? You know, this is the big one, right? When you're looking at a stock, are you staring at an incredible bargain that nobody else sees? Or are you about to walk straight into a classic value trap? Honestly, getting this right, that's the whole game. Now, if you crack open a finance textbook, it'll give you this very neat, very mathematical answer. It's called intrinsic value. And the way people usually calculate it is with a formula called discounted cash flow, or DCF. It tries to guess all the cash a business is ever going to make, and then it adjusts that for the fact that $1 today is worth more than $1 tomorrow. It sounds perfect. It's clean, it's logical, but, and this is a huge but, there's a catch. And leave it to Einstein to just nail the problem perfectly with this quote. The math, the formula itself, yeah, that's certain. But the messy, unpredictable real world it's trying to describe, not so much. See, the formula demands that we know the future, and that is where the whole thing starts to get really tricky. So this leads us straight to our first big problem in judging value, what our source material calls the garbage out problem. And it really gets to a fundamental mistake in how a lot of people try to figure out what a company is worth. The DCF formula itself is flawless. It's just math. But to make it work, you have to feed it numbers. You have to tell it what a company's earnings will be in the future, what its cash flow will be, what interest rates will be. But where do we get that data? We can't, right? There is no data from the future. All we have is the past. And we all know the future rarely looks exactly like the past. And that leads us to that old saying from the world of computing, garbage in, garbage out. If your assumptions about what's going to happen 10, 20 years from now are basically wild guesses, or let's be honest, wishful thinking, then that super precise number that the formula spits out at the end, it's garbage too. It just gives you this false sense of precision about a number that could be completely and utterly wrong. Okay, so if trying to perfectly predict the future is a trap, what do we do? Well, is there a better place to start? Let's talk about a much more down-to-earth approach, one that begins with what's happening today, not what we hope happens tomorrow. It's called the annuity formula, and look how simple it is. Instead of some crazy complex spreadsheet, it's just basic division. You take the income the company is making right now, and you divide it by a discount rate, which is really just the yearly return you want on your money. And just like that, you've got a baseline value. Sure, it's a simplification. It assumes today's profits just keep rolling in forever, but it's a powerful one because it's anchored in reality. This really lays it all out, doesn't it? DCF is this complicated theoretical machine built on a whole bunch of guesses about the future. The annuity formula, on the other hand, is simple, it's practical, and it's built on the solid ground of what the business is doing right now. It's just a much more sane place to start thinking about value. So building on that simple starting point, we get to the real meat of the idea, a 4-part checklist. I want you to think of this as a filter. It's something you can run any potential investment through to spot the weak spots and hopefully steer clear of those nasty value traps. All right, first step on the checklist is profitability. And this is all about the here and now. The question you're asking here is simple. Is it cheap compared to what it's earning today? A high earnings yield, which by the way is just a different way of saying a low price to earnings or PE ratio, is a fantastic starting point. It connects right back to that simple annuity formula we just talked about. Basically, are you getting a good deal on the profits the company is already making? Okay, number 2, we have to look beyond just today's profits and think about growth. And this is important, not just any kind of growth. So the real question here is, does the company have a moat? Like a castle. Does it have some kind of durable competitive advantage? Something unique that competitors can't just come in and copy tomorrow? Because without a moat, as soon as a company starts to grow, rivals are going to swarm in and eat up all those extra profits. So this is all about the quality of the growth, not just the raw number. The third element is one that people often forget, but it is absolutely critical. And that is lifespan. A business can be cheap, it can have an amazing moat, but none of it matters if it doesn't stick around. So you really have to ask yourself, is this company built for the long haul, or is it vulnerable? Could a new competitor wipe it out? Is it just a passing fad? Or has it taken on a mountain of debt that could sink it? A long lifespan is what gives your investment the time it needs for that value to really compound.
And that brings us to the fourth and final element of our checklist,
Which is certainty. This is all about how well you can actually get your head around the business. So are its finances boringly stable and predictable, like, say, your local utility company? Or are they all over the map, totally volatile and uncertain, like a company that just digs stuff out of the ground? The more certainty you have, the more confidence you can have that your whole analysis isn't just a shot in the dark. Okay, so the theory is great, but let's put this framework to the test in the real world. Let's rewind the clock to 2010. You've got the health insurer United Health. On paper, it looked cheap, but it was staring down this massive, massive uncertainty. The brand new Affordable Care Act, also known as Obamacare. And this is what I love about this slide. It just cuts right through all the noise of the headlines back then. Look at this. United Health passed the first 3 tests with no problem. Was it profitable? Yes. A really low PE? Did it have growth potential with a moat? For sure. It was the biggest player with huge advantages. Did it have a long lifespan? Yeah, a very durable business. The entire decision, the whole investment case, came down to that one last box: certainty. Could its business model even survive this massive government overhaul? That was the only question that truly mattered. So, after all that, what have we ended up with? We've ended up with a really practical toolkit. A way to make better decisions, not just with stocks, but really in any situation where you're trying to figure out what something is worth. And this right here is the big takeaway. This 4-step checklist isn't some magic formula that guarantees you'll always be right. It can't. But what it can do is dramatically improve your odds. It forces you to look at a business from every important angle: the price, the quality, the durability, and the predictability. And that helps you sidestep the most common ways people get into trouble. So let me just leave you with this one final thought. We've talked about this as a powerful way to analyze a company. But what if you applied this framework to other things? What about a career move? Or a really big purchase like a house? Or even just a new project you're thinking about starting? How might checking for profitability, growth, lifespan, and certainty change the way you make decisions there? Something to think about. Thanks for tuning in.
So today, we're going to jump right into the 1990s tech bubble. You know, it was a time of just wild optimism, revolutionary technology, and, well, a crash that completely vaporized trillions of dollars. It was an era where everyone thought the old rules of investing were dead, but were they really? Let's dig in. And this quote from George Soros, it absolutely nails it. It's the key to understanding how these things happen. See, bubbles aren't just random craziness. They almost always start with a powerful, compelling, and often correct idea like, hey, the internet is going to change the world. The problem is when that reality gets all twisted by a huge misconception, and that misconception is almost always about price. Okay, so before we really get into the anatomy of the 90s mania, let's just get on the same page. What exactly is a financial bubble? Well, here's a pretty good working definition for you. It's when a whole group of assets, like tech stocks, starts trading at prices that are just completely unhinged from their actual fundamental value. It's kind of like paying $100 for a $50 bill just because you hope some other person will come along tomorrow and pay you $110 for.
And that leads us to probably the single most important question you can ask to spot a bubble. Seriously, forget about trying to guess what happens next. The real question, the one that keeps you grounded, is this: what's it worth? It forces you to stop thinking about momentum and start thinking about value.
So, how do we even begin to answer that question? Well, here's a simple rule of thumb that historically has been surprisingly on the money. It's the price-to-earnings ratio, the PE. Basically, it's how many years of a company's profit you're paying for it when you buy the stock. And history shows that when a big group of stocks starts trading for more than 30 times its earnings, it has almost always ended in tears. So just keep that number, 30, in the back of your mind. So how in the world did things get so completely out of hand in the 90s? Well, it wasn't just one thing. It was this perfect storm, a convergence of 3 really powerful forces. You had these 3 core ingredients in your bubble recipe. First, easy money, which made it super cheap to speculate. Second, globalization, which was opening up huge new markets. And third, the game-changing promise of new tech. Now, what's so crucial to remember here is that these were all fundamentally correct ideas. The world really was changing. And that easy money part? This shows it perfectly. The 10-year government bond yield is kind of like the base interest rate for the entire economy. As it dropped like a rock, borrowing got way cheaper, and stocks started to look a whole lot more attractive than bonds. This was basically like pouring gasoline on the fire.
So with all that fuel sloshing around the system, the market went to a state of just pure mania. This is the part of the story where logic pretty much goes out the window, and the fear of missing out, FOMO, just takes over completely.
And this quote from a tech broker back then just perfectly captures the attitude. Any kind of skepticism was met with this mantra of, this time is different. Old ways of valuing companies? Oh, those were for dinosaurs. If you question things, you just didn't get the new paradigm. It was a really powerful way to shut down any kind of debate.
And boy, did the new companies come pouring in to cash in on the hype. In 1999 alone, more than 400 companies went public through an IPO. A lot of them had little more than a vague business plan and a .com tacked onto their name.
And get this, the average new company hitting the market saw its stock price double in a single day. This created this crazy illusion that you literally couldn't lose. If you got a piece of a hot IPO, it felt like someone was just handing you free money, and that just fueled the frenzy even more.
This is just the perfect example of the total disconnect from reality. Check out Sycamore Networks. It was a real darling of the era. At its absolute peak, the stock market said this company was worth $44 billion. Okay, so what about its best year of sales? Just $374 million. And its operating profit? A big fat zero. The stock price had absolutely nothing to do with the actual business. So why? Why do people, even really smart people, get sucked into all of this? The what happened is one thing, but the why it happened, well, that's rooted deep in human psychology and how crowds behave. Okay, this little game theory experiment explains bubble behavior perfectly. Imagine we're auctioning off a dollar bill. The winner pays what they bid and gets the dollar. But here's the twist. The second highest bidder also has to pay their bid, but they get nothing. So the bidding goes past 50 cents, then 90. Now say you're the second highest bidder at 99 cents, and the top bid is $1. What do? If you stop, you're guaranteed to lose 99 cents. But if you bid $1.01, you might win the dollar and only lose a penny. See how the game shifts? It's not about winning anymore. It's about trying to avoid being the biggest loser. And that's how everyone gets trapped. That's a bubble. And this famous quote, it just sums up the feeling perfectly. Even the pros, the people who knew the market was way overvalued, felt this immense pressure to keep playing the game. The risk of sitting on the sidelines, looking dumb while your competitors made a fortune, and maybe even losing your job, that felt way scarier than the risk of the bubble eventually popping. I mean, the author of our source material here, who was a really disciplined value investor, was actively punished for not joining the party. His clients pulled about half of their money out of his funds to go chase the hot tech stocks. They saw his caution as just bad performance. That's the kind of intense career risk that forces everyone to keep dancing while the music's playing. But, the music always stops, and when it finally did for the tech bubble, the crash was brutal, and it was fast. Just look at the NASDAQ 100. That's the index full of all the biggest tech stars of the time. It fell an unbelievable 78% from its peak, almost 4/5 of its entire value just gone, wiped out in a little over 2 years. The destruction of wealth was just immense. And for individual companies, it was even worse. Take a company called CMGI. It was this huge internet company, one of the most important stocks in its index. It had returned 1,000 times the initial investment for early believers. After the crash, it eventually became totally worthless. It just goes to show you, even the biggest champions of the bubble era were not spared.
So, what's the big takeaway from all this? What's the timeless lesson here? It's that you can't predict when a bubble is going to pop or how high it's going to go before it does. That's totally out of your control. But you know what you can control? You can control how much risk you take, and most importantly, you can control the price you're willing to pay for something. That is where all your power is.
And that really leaves us with this final thought. The story of the internet wasn't wrong. It absolutely did change the world in incredible ways. The story behind almost every bubble is built on some kind of compelling truth. The fatal mistake is forgetting to ask that one simple, grounding question. Is the price right? So when it comes to investing safely, you've got these two absolute legends, Warren Buffett and Jack Bogle. But here's the thing that'll make your head spin. Their advice is the complete opposite. One guy says to hunt for individual stocks, the other says just buy the whole market. In this explainer, we're going to crack that code. We'll reveal the one surprising principle that both of their philosophies are built on, giving you a real blueprint for how to invest with confidence.
All right, so on one side of the ring, you've got Warren Buffett, the active genius. His whole game is about finding that one needle in the haystack, that single amazing company that everyone else is overlooking. And then on the other side, you have the passive pioneer, Jack Bogle. And he famously said, "Don't look for the needle in the haystack, just buy the whole haystack." And that's exactly what his invention, the index fund, does. It just aims to get you the return of the entire market.
And right there, that's the big puzzle we're going to solve. I mean, how can two strategies that are polar opposites both lead to financial success? And, maybe more importantly, peace of mind. Is one of them secretly wrong, or is there something much, much deeper going on here? Well, it turns out the answer isn't in what makes them different, but in what they actually share. See, both Buffett and Bogle, even with their conflicting tactics, built their entire worldviews on a set of core safety principles. And these rules are all designed to protect you from the one thing that can absolutely wreck any investment plan: regret. And we're calling them the 5 margins of safety.
So here's the plan. Both of these icons agree on these 5 rules. You gotta tame your emotions, you have to know your limits, trust your agents, build a fortress, and, this one's huge, never ever pay full price. Let's dig in and see how they each use these rules, starting with number 1.
Okay, rule number 1, tame Mr. Market. This is where the real war of investing is won or lost. It's not on the spreadsheet, it's right between your ears. Both Buffett and Bogle knew that if you let your emotions run the show, they can become your portfolio's absolute worst enemy.
To really get this, you need to meet Mr. Market. Just imagine he's your business partner. And every single day he shows up at your door either totally euphoric or completely terrified, and he's just screaming prices at you. Some days his offers are a total steal, other days they're just nuts. The whole trick is to learn to ignore his mood swings and use his moments of craziness to your advantage, instead of letting yourself get swept away by them.
And here is a perfect example of Buffett doing just that. Back in the mid-70s, Geico was an absolute train wreck. I mean, look at this list. The company was hemorrhaging cash, it was about to go bust, the CEO got canned, Mr. Market was having a full-on capital P panic. But Buffett, he saw right through the chaos. He understood the real value of the business underneath all that fear, and he invested a ton of money, turning the market's panic into his single greatest opportunity.
Now, Bogle's way of taming Mr. Market is totally different, but it's just as powerful. He basically makes investing, well, boring. Yeah, you heard me right. Think of an index fund like one of those bland diets this quote mentions. The reason it works is because it's not exciting. There are no hot stock tips to chase, no dramatic company stories to get you all worked up. It's a system designed from the ground up to protect you from your own worst emotional impulses.
And that leads us right into our second rule, which is all about knowing your circle of competence. This really boils down to intellectual honesty, which is this surprisingly profitable skill of just admitting what you don't know.
To put it simply, your circle of competence is just the stuff that you genuinely get. It's not about being a genius who knows everything. It's about knowing exactly where the edge of your knowledge is, and then having the discipline to stay inside it. And this is a great look at Buffett's own circle. Inside, you see the things he understands inside and out. Big brands like Coke, the insurance business, simple finance. But look at what's outside his circle. Most tech, complex derivatives, basic materials. You know, for decades, people gave him grief for missing the tech boom. But his logic was simple and unshakable. He just doesn't invest in things he doesn't fully understand. Period.
Okay, so what about the rest of us? Well, for a Bogle-style investor, your circle of competence is the S&P 500 itself. It's the whole market. You're not making a bet on one company you think you understand. You're making a bet on the long-term growth of the entire American economy. It's a beautifully simple, ready-made circle of safety that pretty much anyone can grasp.
All right, our next 2 rules are so connected that we're going to tackle them together. It's all about building a fortress. This is about protecting your investments from 2 huge threats: people you can't trust, and a simple fact that things fall apart over time. So it's about making your portfolio both trustworthy and durable.
So how do these 2 guys build their fortresses? Well, Buffett's method is to find fantastic companies that have great managers and what he calls a wide moat, basically a competitive advantage that's hard to overcome. Then he trusts them to do their thing.
Bogle, on the other hand, builds his fortress using diversification. By owning a tiny piece of the 500 biggest companies in the country, the failure of any one company or the bad behavior of any one CEO becomes almost completely irrelevant to you. But what about that other threat, just obsolescence? Companies dying out? This slide, wow, this is a real shocker. Back in the 1960s, a company could expect to be in the S&P 500 for about 60 years. Today, that's dropped to just 16 years. The world is just changing faster and faster. And this, right here, is where the simple genius of the index fund really shines. It's like a self-healing system. It automatically kicks out the dying companies and brings in the new, innovative ones. It's a fortress that literally rebuilds itself over time.
And now, we've come to the final and maybe the most important rule of them all. Never, ever pay full price. This is your ultimate margin of safety. It's that critical cushion that protects you when, not if, but when you are wrong about what the future is going to look like.
Let's look at a classic Buffett move, the Washington Post. This was back in the 70s, right in the middle of the Watergate scandal, and the market was completely freaking out. As a result, the stock market valued the entire company at just $110 million.
But Buffett, like he always does, did his homework. He looked past the stock market noise and checked out what similar businesses were selling for in private deals. And what did he find? The Washington Post's assets were actually worth at least $400 million. That gap, that is the margin of safety. He got to buy a $400 million asset for $110 million. So even if he was a little off in his math, he was still getting an incredible bargain.
Bogle's version of never pay full price is all about one thing: fees. His costs matter hypothesis is so simple it's almost genius. As an index fund investor, you are guaranteed to get the market's return. The only thing you can really control is how much of that return you give away in costs. So by pushing those costs down towards zero, he makes sure you keep more of what's rightfully yours. For him, slashing costs is buying at a discount.
So, we've looked at these 5 rules from 2 totally different angles, and that brings us to the most important question of all. Which path is the right one for you? See, it's not about which strategy is technically better. It's about which one actually fits your personality, your goals, and how much risk you can stomach.
So, who are you? Are you a Buffett? Do you have the emotional steel and the deep curiosity to do the hard research, to wait patiently while everyone else panics, and then to act decisively when they're all afraid? Or are you a Bogle? Do you prefer a disciplined, low-cost, systematic path that just harnesses the power of the whole market without needing to find a needle in a haystack? The answer, honestly, is deeply personal.
And that really brings us to the final thought, and it comes from Buffett himself. You know, the biggest mistake you can make in investing is to just keep digging, to keep following a strategy that is fundamentally a bad fit for your personality. The real secret to safe investing isn't finding the perfect stock or the perfect fund. It's finding the strategy that is perfect for you.